All right, so good morning, good afternoon, depending on where you are joining from. We are in the last week, almost last week, and what a month it has been. So finally, we are getting Santa Claus rally. Looks like. What caught your eye this week? What you're looking at? Let me make sure that I can hear you guys.
Good morning, Vivek bhai.
Yeah, now I get it. Thank you for helping me do my speaker check. ABC saying shorting silver. Oh my God. Silver has been on tear. And that reminds me, I think way back, there was an article in Barrons that we discussed in this meeting, which was saying if you miss the gold train, you might want to get on the silver train. And which was basically, I think that article talks about the divergence between the gold and the silver performance. And at that point of a time, that divergence was way more than what the normal movement between silver and gold has been, like as a pairs trade, right? Gosh, I didn't take a position in silver then, but silver has been on tear, man. I mean, 6% on Friday. uh, I look at the SLV is my vehicle. I mean, SLV is up 164% for the year, right? So if nothing else, these called boomer metals have been just ripping and outperforming the best companies of the world. Right? Look at gold. Gold has been GLD has been on tear. GLD is up like almost 70%. And now we got a silver up 160%. It is what it is. I'm not shorting silver, nor I'm chasing this rally. Looks to be pretty overly extended though, right? If I uh, outside of two standard deviation move, looking at last year to date data, seems pretty extended. But who knows? The craziness can continue. So I'm not going to short, but I'm not chasing it either. Jose saying, was it up 10%? I know. I mean, I knew that on
Yeah,
Friday,
Friday was 10%.
10%. I mean, I watched it till it was like showed 7%. I'm like, what is driving this? Was there anything specific?
It's the yeah, the price in Shanghai is the spread got really big. So you know the market in the US is derivatives market
Hmm. Hmm.
and there it's physical. So I think like over here we the people that it's just paper. We don't actually have the silver.
Yep. There have been a video circulating now on Singapore and Southeast, Asian countries of how people are lining up to buy gold in front of jewelry, gold jewelers. I don't know. Some of them are probably old. Some of them may be new, but to me, it looks like too much too soon. So I'm not chasing this rally. So I'll sit outside, watch what's happening. Lot of macro drivers. China halting silver exports beginning of year. Silver does have some industrial use, but who knows? And I think at least when it comes to silver and the gold, we have seen these, if you extend the time period and go back like last 20, 30 years, we have seen these burst, these movements which come in short bursts, and then it will die down, won't do anything for a decade. Like gold didn't do anything for almost a decade. And then
Yeah, but
over the last two,
have you
yeah.
zoomed out on silver though? Like it just broke out of a huge cup and handle. Like
Yeah, let's go back and look at what 20-year. Okay, maybe I should get oh, let's do 1 month. Oh, let me then maybe change the time period to a monthly. Wow, looking at a monthly wise, Jesus, look at this.
it's breaking out of a technical pattern, so it's gonna go triple digits, I think this
Yeah,
year at least.
kudos. But it is what it is. Yeah, if you have been you are in the silver trade, it's probably has been a great trade. But like I said, it's run out in 2011. So from 2011, and these are like monthly candles, we didn't get back to that level until we are in 2020. Oh, let me just change it to the pricing instead of showing percentage. Yeah, we didn't hit SLV back at that same level until 20 until November. That's been a long wait. But anyway, it is what it is. I am not in this. Happy for those who are on this train. I was in silver, but I think at 46 is where I had my covered call. That got called away, and I said I'm not chasing it. Silver does have an industry, so Jose, you're saying, yeah, we do have some use of silver in industrial usage, in electronic circuits, phones. I don't know if it has got a battery usage or not. Mike is saying, picked up the book Expectation Investing. Yeah, Expectations Investing is a heavy book, right? So that's why I've not yet finished it. But Mike, when I was already doing the reverse DCF kind of a stuff, which to tell me what's expected, what's expectations that market has based on the current pricing. So when I was reading the book, it actually also talks about a similar concept, right? So rather than you trying to figure out which is, hey, what's your the value, what's the company valuation running the traditional DCF model, where you project out what the cash flow is going to be for the next 10 years, then at a steady state. So you make a lot of assumptions in coming at that numbers. Expectations investing started with, okay, forget about the future because I cannot predict the future. All I'm going to look at the current market pricing, what the current price is, what is market expect, if you assume that the market is efficient, looking at the current price, what is market priced in, what's the growth priced in. Now you could look at a growth from a cash flow perspective, or you can look at a growth from to achieve that cash flow, what the revenue etc would be. So that's what I think. I've read only half of the book, and it basically was talking about that. Rather than trying to predict the future, we just try to look at what's expect market is expecting out of this stock. And again, I mean, I would love to read a different investing philosophies and concepts. So this was one of them. But it's heavy, and all Michael Mauboussin writings are a little heavier on mind. So I'm finding it difficult to finish that book.
Hard to
Tom's is
come away.
saying,
Yeah, go
sorry,
ahead.
go ahead.
No, I was just quickly saying that it's hard to come away with actionable formulas or decisions which one can implement by looking quickly at the financials of a stock.
Yeah,
It's you have to create a whole new evaluation framework based on what you just said, like reverse engineering the price.
correct. And Michael Mauboussin's articles are always like that. Uh, he will dig deep. I don't know, but I always read whenever the new article from him will come out, because he does go deep into analysis and basically good research. Howard Marks, on the other hand, is easy on mind. CME has raised margin requirement for silver again trading Monday. Okay, I'm not a big silver trading guy, but looks like a lot of stuff happening on the silver side. They use silver in missiles. Samsung recently gave out a loan to silver mine. Oh, geez, a lot of demand drivers. Sure. Cool. What else? Before we jump into today's session, anything else caught your eyes? How about the Nvidia buying, not buying grok, but kind of a buying grok? GROQ saw that merger. like Monday merger. That did happen on Monday, right? It was like after in the middle of a week. That was another big news on the market. We saw Nvidia kind of doing acqui-hire, just like Google bought Windsurf, not really buying it, but basically getting all the IP and then the key people. Similarly, Nvidia bought a company called Grok, and Grok basically focuses that the founder of Grok was also the father of 10 TPUs from Google. So I NVIDIA knows that GPUs will not be, will have a competition when it comes to inference. GPUs probably are the best for training, but when it comes to inference, there are other technologies or processes you can use, and they just bought one of them. And if you really want to get deeper into what differentiates these LPUs that Grok is working on versus GPUs, how they are different from other. They use basically static random access memory, make use of that to run the inference really faster. Look out for explanation from Gavin Baker on Twitter. He has done a good job of basically telling, dissecting why NVIDIA did this acquisition. I mean, it's like $20 billion, right? It's not a small one. Probably is it really the biggest one, or was the Mellanox biggest was bigger than $20 billion? If not the biggest, it's probably one of the biggest spending from NVIDIA to cement their position in, in training, they're already the biggest, but even on inference, they want to uh, be the best. Narcis, you mentioned Michael's article. I'm not a particular article, but if you just search for Michael Mauboussin and his memos, he publishes memos at a regular frequency. So I basically keep track of all those memos and just read through it. It's a good read. I don't know if there is some website that has got all the memos listed. Maybe somebody has done that job, but um, it's a let me see if I yeah. So it's Michael Mauboussin letters, and let me just give you the name of that gentleman so that you can search for it. He also teaches at Columbia University. There we go. John has shared, probably this is the page where you have all his letters available. What else? Anything else in your mind? What else do you see in the market? This being a low volume market, people are enjoying holidays. So am I, taking it easy. Why interrupt Santa Claus rally? Right? We never.
Hey, my name is Suresh with an R. First time attending this. Had a question. I was hearing, the guy who called the shots for the 2008 market with the financials is wanting to short Nvidia, right? Saying that's a big bubble. Don't know if you guys have discussed it already before, but if not, any commentary on that would be great.
Yeah. See, Michael Burry, once he got his right, we've been paying a lot of attention to what Michael Burry says. He not only shot NVIDIA, he's also shot on Palantir. One day he will be right, but I don't think NVIDIA is at a place where I consider it as a short candidate. It is still uh, pretty okay valued. It's not overvalued. Not NVIDIA. There are companies in the similar space which I find overvalued, but NVIDIA is at a very decent valuation. I think its forward P is even less than, it's maybe around 25 or something. It is cheaper than some of the retail like Walmarts or the Costco's of the world. But If you look at the history of what Michael Burry has been doing, he's probably called out recession and market crash. Market will crash maybe 10 times since 2008. And every time he's been proven wrong. One day he will be right. Let me put it that way. One day he will be right. But I'm not gonna go and short Nvidia. Not at current price, wherein I don't see it to be an overvalued. Looking at their forward, even if you go with the traditional valuation methods, forward P is not that high. So I'm not gonna short it. But yeah, people pay attention to Michael Burry because he made decent amount of money for himself and his clients during the 2008. But that doesn't mean he's gonna get all his predictions right. I mean, look at Rich Dad Poor Dad. Robert Kiyosaki has been calling the collapse of market for more than a decade. Who cares? So yeah, you should decide in terms of what works for your portfolio. I am not gonna short Nvidia.
You mentioned while you're talking about that, comparing it to Walmart and Costco and stuff, which I think has over a 40 PE. Any thoughts on why? I mean, yeah, I haven't been in this details in a while, but used to be the whole peg ratio, right? It seems like Walmart at 40 plus is way over even on a peg. Any thoughts on that?
No, I don't know why Walmart is trading at the price at which it is trading right now. I know even Costco was like super high valued in 2024, and we used to discuss and say, why is like Costco trading at it? And I know Costco is not just normal a retailer, it's got a big subscription revenue that probably will give it a little higher multiple than just a retailer. But still, it was trading at like 50 times for its earnings. It didn't make sense to me. 2025, Costco has corrected, but I think it's still overvalued. And markets can stay irrational, right? Markets, I don't know who said it, but someone said it. Markets can stay irrational longer than your portfolio can stay solvent. So I'm not going to chase these rallies. I just want to make my own individual decision on, does it make sense for me to buy Walmart at the price point where it is right now? I will not buy it. It doesn't gel my style of investing, but if you want to, go ahead. Sometimes there are no reasons why will the stock will just go up and up. And sometimes we get lucky, right? That's where the luck comes in. And if you are on that train and Walmart train or Palantir train, you made some money, you got lucky. But that doesn't mean that it was the right decision to take.
Agreed.
Yeah, that's
Sorry, one last question on the that Nvidia one, right? I was just while you're talking, pulled it up. You said you're looking at forward PE being in the 20s. The current PE was at about 47. When you're looking at forward, is it next 12 months or what time period are you
Yeah,
looking
that's the next 12 months, right? Looking
at? Okay.
at let's look at the stats. What does it say forward PE? 27. Not that
Okay.
expensive.
Okay. So that's the next 12 months. All
Yeah.
right. Thank you. Appreciate the feedback.
No worries. Again, I can't tell you, I mean, in terms of what you should do, the investing is very specific to one's own makeup in terms of your emotional makeup and what your needs are and what you already have in your portfolio. Uh, I am not gonna short Nvidia. I'm also not gonna short silver, even though silver seems to be so overextended. But who knows, the craziness in the market can continue for longer than I can hold my short position. So
Which was
why?
the last stock did you short?
I don't think I ever short it. So for me, the way to take a
There you go.
when you say short, unless a negative delta
You didn't
position
take a
would be.
position ever in shorting a stock, right?
Yeah. So I will if I were to go short, let's say I did Oracle, but then I bought a put spread on Oracle rather than trying to short the stock. When after the Oracle was up like 30% after its Q2 or Q3 earnings, and I'm like, they have a $400 billion of RPO which projected, and we know what's the constituent of that $400 billion, where it was coming from. And I thought that 30% jump was too much too soon, but I still didn't go and short the stock. So I bought a put spread. I think that's my maybe only put spread that I bought this year was on Oracle, and that did pan out well. I will do a negative delta trades, but I'm never gonna short the stock. After seeing many of the much bigger hedge funds blown out in 2021 or in the short bursts, some shorting the natural gas, I've decided I'm not gonna short. Plain and simple. There are easier way to make money, so why make it difficult? If shorting was the only ways to make money, yeah, you can put a case or hey, you should short. Come on, there are many other ways.
So
Better.
there are periods, just like when it's prudent to be bullish, there are periods when it's prudent to be bearish, like between middle of 2022 2022 to 2023. I made good chunk being short, weak stocks, and because the trend was going down, right?
Yeah, so I made good money on my options, all on my negative delta trades in 2022,
Okay.
right? So, but again, those are mostly using derivatives. I might sell a call spread, but I'm not gonna short the stock naked. Plain and simple. Uh, like what Charlie Munger says, right? Find what can wreck your portfolio, never do the stuff. One thing which I've not seen, but I've seen other people wrecking their portfolio because they got too confident, too cocky, just like silver, right? And I just don't want to put myself in a position wherein there is a way that market can wreck my portfolio. That's it.
Good idea.
All right. What else? RAM prices exploding 3x. Samsung and Hynix are inside ETFs like EWY. So we will look at some of the international ETFs because I do want to cover in today's topic quick review of 2025. So in which I'll cover what we saw in the US versus international performance. Cool. Shall we get started? Or is there anything else? All right. So maybe we'll start with a regular discussion and welcome everyone to our discussion number 305. Talking about the stocks, investing, bonds, IPOs, crypto, whatever is under the sun as a retail investor we can make use of. It's on the menu, right? And today I want to, since this being holiday season, I do want to focus a lot more on learning side. So today, a couple of topics. One is definitely review of 2025. And then also we're going to go through some of the predictions from the Wall Street firms on 2026. I call it as a reckless predictions because no one knows what future entails. I'm not claiming whatever they are saying is true or not, but sometimes makes sense to look at what these Wall Street firms are thinking about directionally, right? So we'll go through that. I also want to share as a part of our learning around investment in terms of an experiment that I started with my kids in trying to teach them the value of money and value of investing in 2015. So it's like 10 years in the making. So I thought I'll share. I basically thought put it on LinkedIn, and then I saw people interested in it. I thought I'll come and share that experiment with you guys. If you have kids or young adults who are in a stage where they are still malleable, will still listen to you. Maybe you want to have that discussion. So that's on today's agenda, and then after maybe around 12:30. We'll open it for breakout rooms. You want to go and talk around any specific topic. We have a breakout rooms for day trading and charting and fundamentals, multi-baggers, whatever. So you can go and talk to the other fellow investors with similar interests. Cool. All right. As always, anything that we discuss here is only for education. So please don't trade and invest based on what you hear, over the next 2 hours. Always do your own due diligence, right? One thing which at least I have learned is read everything what others have to say, listen to them, but eventually you make your own decision. That's what will build conviction and probably help in investing. Looking at what's hot in the market, what others are doing, and I don't care. The others may have a very good track record. Kathy Woods had a great track record in 2021. Michael Burry had in 2008. Every new uh, bull market brings in a new, I would say, investors or the star fund managers, right? There have been very few, I think maybe you can count on your hands, this fund manager who have been performer in all seasons. So Tom Lee, maybe 2023, 2024 belong to Tom Lee. 2025 not. I don't know. Maybe he'll be the star fund manager for the next year. We'll see. So always make your own decision. Okay, so start with I want to start today's discussion with one of the money experiment with kids. Again, the whole idea was just, you know, try to inculcate a habit of a saving and investing and see it in terms of how it makes difference in their life. Hopefully they will carry the lesson in their adult life and do a much better job than what their dad did in terms of investing. If they do it, I'll consider this experiment to be successful. But in any case, 2015, I started this because you we generally kids do chores at home and all that stuff. We don't pay for doing that because that's here as a part of family, you gotta do it. But then we'll have them do something outside the regular chores, and then we decided maybe we should pay them for those kind of a work, right? Sometimes I'm cleaning my car and my kid wants to help me clean the car. If you help me, maybe I'll pay you whatever the predetermined amount for helping clean my car. Or why don't you rearrange the books on my shelves? Or why don't you help mom in XYZ stuff, right? Do My wife, she runs a tutoring business, so we used to receive a lot of check payments coming from parents, and one of my kid was, you know what, I'm gonna go and deposit the checks. Sure, you do a mobile deposit or you walk over to the ATM, and we decided for every deposit you're gonna get paid X, so many cents. Or if we walk to the ATM, and I told her, if you walk to ATM with me, my idea was to get her out of a house. We go have a dad and daughter time while we walk towards the ATM. I said, if you walk to the ATM, you're gonna get paid $2 for walking to the ATM, and then 50 cents for every check that you deposit, right? Stuff like that. Uh, and uh, and so this is how we started. And I said, now when you get that money, you have two choices. One is that money goes into our fictitious account under the bank called National Bank of Papa, and you can keep it in your checking account, which is available for you to spend the money, or you can move into a fictitious investing account, and I will do 1:1 match, right? Just like corporates will do 401k match. I said, I will do 1:1 match of any money that you're moving from your regular checking account into the investment account, but you're not gonna have access to that money until you go to the college, until you go to college. So now that means whatever you've earned, you have access to that to spend something that, some spending, let's say I won't approve of. Let's say you want to give a birthday gift to your friend, which is super expensive. Yeah, I'll approve $50 gift, but you want to say, oh no, no, I want to give $100 gift to my friend's birthday. Okay, are you gonna pay $50 from your earnings? That's available in your checking account, right? So that was the whole idea, that money is available to you to spend the way you want to, but the money in an investment account is not available to you, right? So, and I said, the investment account, I'll do 1:1 match, and it grows at 1% per month approximately. I'm like S&P plus dividend, round off, make it 12% per annum. I'll do 1% per month, right? And that's all we did. And we used to track in Google Sheet. And what I used to do was also take a print out a statement, a so-called statement, and put it in an envelope, address it to the kids, and put it in a mailbox. Then while I take out the mail and go and give it to them, and then we'll sit together and we'll review it. The whole idea of review was to actually show them, okay, this is the work that you did this month or sometimes in a quarter, and this is what you get paid from your active work. And then this is your investment account statement. This you got paid without doing any work because your investments continue to grow, right? So my whole idea was to have them experience them the fact that if you get early on investing, at some point of a time you will see that initially it doesn't make any difference. They used to complain that I don't have money to spend, because I moved into investment, and then later on they realized it took, I think, maybe 2 years, 2 to 3 years before they realized that the money that they're making into the investment account is actually more than what they make through their active work every month, right? Then they realize, okay, I think for a few years investing felt like pointless, but then they realize, no, there is a value in it. They don't have to work as hard or to make the same amount of money, because now the investment has, the snowball effect has started to kick in. And my promise to them was that we track everything in Google Sheet. Once you go to college, I will transfer the total sum of your checking account plus your investment into your real account, and from there on you manage the way, whichever way you want to. So that's the experiment which I ran, and my, of course, my elder one, she moved to college. I gave all her money to her. My younger one, she is still in high school. She stopped doing active work because once she moved into high school, I don't have time to do all this stuff, right? But her investment account is still kicking in, right? Every month it gets 1%, and that just keep growing. Her investment account still keeps growing. So my idea was to just look at, through this experiment, teach the concepts of delayed gratification, plan ahead. Hey, if you don't need money for next 3 months, you don't have any big expenses coming in next 3 months, do you want to move this into your investment account? Because if you move it today, you're gonna get 1:1 match, right? So those are the sort of discussions or the decisions that kids got to make, and it was entirely up to them where they want to keep money, or where they want to where they want to move to an investment account or a checking account, right? At the end of a month or a quarter, I'll show them a statement of this is how your accounts are doing, right? So like, I just want to show a sample of a checking account, right? After 2021, my younger one, she didn't do any additional work, right? So hey, this is how much you earn from your income. This is your checking account, investment account, because it's keep compounding month after month, a percent per month. And I know real market is not like that, but I wanted to make it easier and say you get 1% growth in your investment account every month, right? So this is where it is, and then kind of a sample account statement is to generate like this. Now there is no active income coming in checking account because she's not working, but her investment income starts to kick in. Anyway, hopefully I think they'll take this lesson and do better than what I did when it comes to investing and saving. Hopefully they'll start early and will be in much better financial position than for their life. So that's all. I thought I'll share this with you. If you want access to this all done on Google Sheet. So if you want the sample of these Google Sheets, just let me know. Just email me and let me at on this email address, and I'll share the Google Sheets with you. At what age group you started? So we started in 2015, right? So I think one of my kid, she was 8 years age. And then the other one was like almost 14 years of age. Right? So yeah, so it's almost, and obviously once they moved into high school, they don't listen to you, and they didn't do any additional work because now I'm busy in XYZ. But my whole idea was to, hey, this is how the world works. If you go to your job, you get paid. Now it's up to you what you want to do with your paycheck. You want to spend it, you want to invest it, and you know, I just wanted to have them that experience before they get into actual job, right? Now it's up to them how they want to live their life. Okay. So it was an interesting experiment. Someone on Twitter had talked about similar stuff. Then it occurred to me, hey, we used to do this. So I thought I'll share this with you. All right. What's your thoughts on 5 to 9? Yeah, so I do have 5 to 9 planned for both of my kids. Now, one of my kids is already out of college. I still have some leftover in it. Probably I'll use it for my other one. But yeah, start as early as you can because then you can get all the growth, and that growth is tax free. And I mean, I've used for my kids. And now with the new administration, it has become even more, I would say, generous in terms of if you can't use it for college, you can convert it to Roth IRA, provided the account has been open for 15 years and I think up to 35,000. You can use it for your other if kids don't go to college, they go to trade school. You can use it for that as well. So you can use 5 to 9K also. All right, so that was my experiment. Like I said, if you want to, you want to run the similar stuff or you want these Google Sheets, do let me know, and I'll share that with you. She said, "Can you adopt me?" You're funny, man. You're funny. All right, so I thought I'll start our discussion with that. I always want to touch something around investing mindset before we get into the, the nitty-gritties of what's happening in the market. Which is now let's look at Niyanka, please share. Yeah, just Niyanka, just email me and so that I don't forget, and I'll respond to you. Yeah, if you have a Gmail, then I can just share that with you guys. All right, so let's talk about the markets and what happened in the markets. Looking at 2025, we had a great returns among all asset classes. Equities were doing good, bonds were doing good. Uh, we had 39 new all-time highs, and this is as of this week. 39 new all-time high. Right? Winners keep winning. Market kept making new all-time high, not only on the US, but we also saw international markets, which generally US generally outperforms the international market. We have seen it for last 10 years, but this year in 2025, a lot of international markets have done much better than US markets. We also saw bonds also outperforming cash. So bonds have posted positive returns. Investment grade bonds had their strongest annual gain since 2020, right? So just looking at the chart, I mean, this is nothing to complain about, man. The markets have been doing good. The only thing you can complain about if you are sitting in cash, hopefully you put that cash in treasury bills and not kept into your big bank checking account, because then checking account doesn't pay anything. But if you just kept in a T-bills or money market fund, you still made 4%, which is way more than what we would like used to make in 0% interest rates, right? So overall, no complaints about the market in 2025. Whether it is equity, whether it is bond, whether it is large cap, mid cap, small cap, markets have done pretty well, right? We also climbed the wall of worry because we had, remember, initially we had a DeepSeek moment. I think was it early Jan, and the market tanked after the DeepSeek came out with their R1 model. And then we had a tariff tantrum. Market has almost hit a bearish territory, was down 19%. But after that, it has recovered back, and now we are looking at what, 18%? When I say market, I'm referring to S&P 500, SPY. We have up almost 18% for the year, which is great considering the fact that we were down 19% in April, right? We had a drawdown of 19% in April. And this is what you get paid uh, for to go through this volatility, right? You could have gotten out in the market after the market fell 10%. They go, gosh, this too much. I can't go through this volatility in the market. Sure, but then you don't enjoy these gains as well. It's a package deal, right? You want to get more than T-bills, you have to go through this volatility. And especially 2025 has been more volatile than, let's say, 2024. 2024 was like small, like grind up. It was one of the most hated rallies. I think 2023 was the most hated rally because whole Wall Street expected recession in 2023, and it was one of the most hated rallies when the market just continued to climb up. 2024, we saw again most of the time it was a very calm market. 2025 was very volatile market, right? And which for an option seller is a great market for us because we could get a lot more premium in 2025 while the market also continued to climb up. So we had a 13 daily moves of more than 2%, right? Which was a combined total of the prior 2 years. 2023, 2024 was slow grind up. 2025, we had a lot more 2% moves than what we had in 2023 and 2024 combined. Stock fell sharply, recession fear. We talked about it during the tariff stuff, 19% from its peak, just barely. Like bear market is 20%, but we were down 19%. And now we have I would say, if if nothing bad happens in next 3-4 days, we are on path to give another 15% returns year over year for third consecutive year. 2024, 2023, 2024, and now 2025. Pretty good returns in the market, despite all the doom and gloom that we hear about what's happening on the international front, Russia, Ukraine, we had a COVID, we have a recession fear, we had tariffs, we had bombing of Iran, all that stuff, right? Markets have climbed the wall of worry and have still been able to deliver good returns. So this is basically I plotted VIX versus S&P. There are moments, I think this was a DeepSeek moment, but there have been moments where the wall was, you know, we got the burst in volatility, but overall markets have done fine. Right? So I'm pretty happy with the markets so far. Don't know what 2026 brings in, but I'm still optimistic about 2026. We have yet to see the benefits of AI actually getting into the real economy, and which should give a boost to productivity. And I think if you look at the street estimates, they have bumped up their earnings estimates for corporate earnings. Now they're looking at 14% on an average. They're looking at a 14% earnings growth, which is higher than what the projection was for 2025. 2025, we were looking to around 12% earnings growth. Now, and these numbers could change at a moment depending on how the administration policies might turn out to be. But right now, I think the street is expecting 14% earnings growth for 2026. Right? And I'm of a believer that the market will follow how the business would do it. So I'm still pretty optimistic about 2026. That doesn't mean, but you have to position your portfolio also considering the fact that there could be volatility, right? Because still be optimistic. I mean, long term, I'm an optimist investor. I think the markets will go high, but that doesn't mean that there will be no volatility in it, right? And if your survival depends only on your income from your investment portfolio, then you have to make sure how you position your portfolio so that you can survive that volatility, survive that drawdowns, and still be active in the market. Right? There's a like on an average we say S&P gives 10%, but then we also know you have to go through the drawdowns of 30%, like we did in COVID. 2022 we were down 18% for the year, and now we had a drawdown of almost 20%. But if you don't survive that drawdown, the 10% average growth means nothing, right? So you have to position yourself looking in terms of how much bullish you want to be. That's a decision that you have to take. And I mean, I just want to manage my deltas accordingly. So this year, what happened? 2025, tech was still leading the US markets, or not just the market, but we also saw tech also led some of the GDP growth. So this is looking at, we talked about 15% overall S&P 500, but if you look at the tech and the communication sector, now we have a third consecutive year where it is given more than 25%. So if you just held QQQ in your portfolio, which is NASDAQ 100 ETF, probably 25% per year. These are like a VC type returns. So yesterday, this is the last Friday of the month. I do, I do my community service by being a judge on one of a startup pitching event every month. And I was talking to various founders, and we were discussing around investing and all that stuff, and looking at VC, the investment scenario, VC scenarios, startups and angel investing and all that stuff. And now I'm looking at it saying you're kind of getting VC kind of returns even on the public markets. Right? And there was a study which I'd shared long back from Financial Times, which basically had plotted out in terms of the growth, the returns from venture capital, private equity, public markets, and given accounting for the facts like illiquidity, etc., public markets over the last 15 years have done almost same, if not better than how the VCs have done. Right? So private equity is always a mystery for me because you don't do mark to market, so you never know how those have performed. But I mean, you don't really have to go, at least over the last 3-4 years, you don't really have to go far out on the risk curve to make decent returns. Those returns were available in public market with much lesser risk, much better liquidity, and much better information that you have available to make decisions on. Okay. So tech, pretty decent return. So if I look at the 5-year, 10-year, right, communication services 200%, tech sectors almost 700%. Heck, if you didn't invest in any of these sectors specific, you just stuck to S&P 500, not bad, like 236% over last 10 years. Much, much better than holding cash or just money market funds or anything else. Right? So, and this is despite all the things that have happened in 10 years. We got Donald Trump elected twice, and on the international markets, all the stuff that has happened. But still, we've done a decent returns on equity markets. So I'm still optimistic that great companies will continue to figure out ways to make money in business, and eventually, the markets will follow it. Does market go out of whack? Yeah, many times it goes out of whack. Sometimes, many times it will overvalue the companies. We will go through the cycles of boom and, the bubble and the burst. But that's the nature of the markets. That's the reason why we get the returns that we are getting, because we have to go through those cycles. So just make sure you positioned yourself, and portfolio wise as well as in your mind, that these come as a package deal. The volatility and the returns come as a package deal. You can't get one without the other. As long as you understand that, I think life will be good. You won't be shocked if the market goes down 20%. Not just the market returns, but I think the tech also was responsible for a lot of economic growth in 2025. And if you look at the GDP numbers, all the growth in GDP in the second half came through the data center investments. If it did not have that data center investment, probably would have had a flat GDP, no GDP growth for later half of 2025. So now we could sit and debate here, it's too much too soon, when will those projects will pan out. We'll see. And I don't deny the fact that there may be over investment going on, but this is how the any life changing technology will go through that cycle. It's pick up any technology starting from 1600s, right? We've seen these cycles of investment, not investment, just over investment, then rationalization, then weaker player getting taken out to the woodshed and just being beaten, and there will always be froth in the market. Has been is We can't change the nature of the market. The idea is to understand how we position and whether I want to play in that or not. So international stocks, which generally have never, no one wants to talk about international stocks, because we've been hearing story of emerging markets, eventually will do better, but didn't do anything for the last 10 years. But this year in 2025, they have outperformed S&P 500, and this is the best outperformance since 2009, international versus US. So far we enjoyed a US exceptionalism. I think exceptionalism is still there, but the returns, between the difference between the international markets and the US has changed in 2025. We had fiscal stimulus in Germany, because after Trump told that we're not gonna spend, you should spend some money on your own defense. We saw fiscal stimulus coming in Germany, and suddenly you will see all the defense companies in Germany, their stocks were like gazillion percent, right? We didn't even know the names of those companies, but suddenly Rheinmetall became a word that CNBC hosts will start to talk about, right? In Japan, I'm not surprised, because we've been talking about the structural changes that the Japanese regulators have been pushing on to the corporates to do better for shareholders. So I'm not surprised that Japan market has done what it has done. Now I think it's up, and the cost, and so the profit margins of Japanese companies were up like 26%. So I'm not surprised that the market is up 30% plus. Plus, we saw some tech growth in Korea and China. I think China tech growth, because they started, all the tech companies were beaten in 2023. I think they are still recovering. But Korea, I mean, TSMC, right? TSMC is a big part of a Korean overall stock market. It's a huge concentration of, in the South Korean market. And given the fact we are seeing in AI, TSMC, SK Hynix, Samsung's, those companies have driven up the market. So I just pulled up the changes year to date for all some international ETFs. This, and Korea is up 88%, almost 90% year to date, largely driven by some of those tech companies. And then,
Taiwan Semiconductor is not part of Korea.
sorry, that is Taiwan. You're right. And even where is That's a big part of a Taiwan. I don't know where Taiwan is 21%. Spain is 73%, South Africa 67, and many of them also got, I think, tailwinds when you're looking at dollar denominated because of the dollar weakness. So, but these are all the countries that have done better than US has done. Right?
I think
20% Japan, and then Taiwan 21% year to date.
I just quickly eyeballed and I see that the first 6 months of this year, certainly these international stock markets did better than SPY, but the last 6 months, actually, it's SPY is still running ahead of the other. Yeah.
So yeah, so maybe all those return came in were front loaded in the first half,
Yeah.
just because the SPY got beaten down in the first half.
I think well the drawdown was there in the IFA and EM also in that time frame of April, but somehow more of the early first quarter returns were I think in the IFA, etc.
We also look at EEM. Let's see which is the emerging markets ETF.
Used to be
Uh,
submerging markets.
um, yeah, that's done better, man. That's up like 30% for the year. So we didn't have to pick, let's say, China or India. So even that has done 31%. And these are dollar denominated. So I think I do have a chart around their local currency versus dollar. So dollar denominated returns on international have been better than what the local currency returns have been, because the dollar has been weaker as compared to
Ah, you're
the prior
right.
year. So that makes little more difference here.
That's the reason. Okay, that
That's
makes
a big reason of outperformance. And let's say emerging markets, I don't see that much, but in terms of small and mid cap, the 10% outperformance is just coming because the dollar, their exposure to dollar and the weakness in dollar.
no, because all these ETFs are essentially hedged, currency risk hedged. So therefore, you don't see the that the dollar reason depreciation reason is there.
Yeah. And then there's another chart which talks about the bonds versus holding cash, right? So basically, we see the outperformance of the return from investment grade bond versus holding cash. Cash on yield basically is the T-bills. So it's still investment grade bond are like close to give you 1% spread over the what the T-bills will give you. So I mean, net, I think all asset classes are done well. And if I go back to look at the sector specific, all sectors have done well year to date. Of course, the real estate and staples, have vastly underperformed. I mean, financials, healthcare, they have underperformed the overall S&P 500, but I can't complain.
But best would be gold or
Yeah,
silver.
gold and silver over the last 2 years,
Just 1 year.
gold
This
and
year.
silver have outperformed everything else. Forget about if you look at there's some stat, then you see these charts coming up time and often. Is if you look at if you pick from it all depends on which time frame you pick up. But if we pick from the peak of 2000 and as of today, gold has outperformed S&P 500.
Wow.
But then you go and pick the peak of 2000, right? And because that peak of 2000, when at that time the gold was one of the lowest, because hey, everyone was investing in the markets, and the gold was at the lowest. And now you look at right now, and if you had bought gold when the market was at peak in 2000, and you just held it, you would have outperformed S&P 500. But you would not have had uh, you would have had a lost decade till 2021. I think all the outperformance in the gold has probably come in last 3 years, right? So GLD, let's go back and do the same stuff. 20-year. Let's do monthly. Let's go by month. Those shit, right? So we're looking at this is 2011. Right, and we were back at 2011 till here, which is November 2023. Not in that. I think the first time it went back to level of 2011 was in 2020, 9 years. And then again, it didn't break out of its 2011 until 2023, April 2023.
And speaking of 10-year gap, like I remember in 2011, for the first time, came back to the same level as 2001. So we had a 10-year lost
Yeah, so we
decade.
had that lost decade.
So there's a phase difference between these time series.
Yeah. And this is where it becomes very important is if you really want to survive, you need to figure out how you will survive that lost decades. I don't know when the lost decade will might come again. And it is very possible that you might get a lost decade once the whole AI euphoria goes down. And the idea trick is to figure out how do you survive that lost decade. And it's not the first time that we had a lost decade. So, but interesting, right? We all talk about gold, but not many people would have had wherewithal to hold gold in their portfolio after seeing it doing nothing for almost 13 years.
Yeah, the standard advice was keep 5% of gold in your portfolio,
Yeah.
but this Jeffrey Gundlach has been saying 25% over the last couple of years. So he fears much more.
And now look at on the, I think what all the Bitcoin, like they're saying Bitcoin has underperformed. It's negative for the year.
Right.
Come on. If you're a Bitcoin investor, you've been collecting like 5x the presents every year. Now this year you didn't get any Santa Claus presents, so now please don't complain. You have had a good returns, right? But yeah, there are times when some of the asset classes just won't work. Anyway, let's get back to where we were. So looking at a fear and greed index, we start to move a little bit on the greed side. And being a contrarian in terms of the market sentiment. When it moves into the greed side, I want to step back and just make sure that I'm not getting in the market with a lot more higher deltas, right? Because generally, um, I take it as a contrarian indicator, and that so far has served me well. So I'll continue to focus on when the market is in greed. I would rather have try to raise more cash and have little more defensive positions than I'll go out for shopping when the market is in a fear or extreme fear. So we'll wait. We'll see. uh, uh, Yeah, yeah. Jose said you have to understand the forex dynamics. If you're investing in any of the emerging market companies like I have, when you're looking at their quarterly results, you have to look at obviously they report the results in dollar denominated because they are listed on US exchanges, but you also have to look for constant currency numbers to understand how the business performance has been. So it's always a challenge because now I have to always compare the take the dollar currency uh, impact out, and when you look for a business performance, then I have to look for constant currency, how that company has performed. That's what I want to judge their management on. And then yeah, then the rest of the stuff come from how the dollar has behaved with respect to their own home currency. Okay, let's talk about some reckless predictions for 2026. Do you want to make some reckless predictions? What's one of your reckless predictions in 2026? Let's talk about. I'll go through that. I think I do have some street numbers. Like we gotta have Apollo, Goldman Sachs. What others I have? Bank of America, Jeffries top 10, Barrons top 10, Evercore ISA idea, Jeffrey Gundlach, we just talked about. So basically, in terms of what his game plan is. But let's talk about some of yours uh, reckless predictions. Let's talk about which IPOs, which company is gonna get IPO. Are we gonna get trillion-dollar IPOs in 2026?
SpaceX, yeah.
Yeah, that's the only one I'm
It's
aware of.
800 billion, 800.
800 billion. How about OpenAI?
I
Will
don't think,
OpenAI go IPO?
no, no, no. It cannot justify, the financials wouldn't justify and let it do a road show.
We don't know how much. I mean, if you
It's
heard Sam
earning some like
Altman,
$15 million or 50 versus $1 trillion valuation.
no, if you heard Sam Altman in the podcast, I won't be surprised that it's in next 2 or 3 quarters they're talking about $100 billion as a revenue.
Hmm.
Right. So let's say in 1 year they get they are on an annualized rate. I'm not saying that for the year 2026 they're $100 billion. Let's say in Q4 of 2026 they're looking at annualized rate of $100 billion as a revenue. Then $1 trillion valuation is not that far away. Right? Then you're just talking about 10 times the sales. Expensive, but not that expensive. Anyway, let's talk about, will this company go IPO?
No. I have been in, okay, so let me wind back the clock. In 2014, there's another company called H2O, which is still there,
H2O AI.
and Databricks. And I was commenting to my friend, like, why these kind of companies would never go public. Why? Because they provide just the libraries or infrastructure, but not an, really sellable product. So in my view, these companies will attract investment. Like Databricks, I'm astonished. It's become like so big in valuation. It's only because we had so much AI hype in the last several years that people who kind of have lots of cash but don't understand products, they kept pumping it in. But I don't think it's gonna go public.
So they did their Series L.
I know.
Right? I'm like,
Tell you
what the
what,
heck is happening?
exactly. This guy H2O guy, he's Sri Lankan, he got a first round of financing of 1.4 million in 2014, and later it was valued at 75 million or some number
So
like that.
yeah, I've not followed S2A. I mean, one of my ex-colleagues, he joined S2AI. I think
Yeah.
he probably runs the
So today we my company uses Databricks, which we purchased 4 5 years ago, but we are slowly reducing it to use Azure cloud and so on. I think essentially it's a replaceable service.
so, or maybe they learned their lesson from, or they watched what's happened to Snowflake and in terms of the public market, and maybe having second thoughts of whether they want to go public or not. In any case, Databricks have been changing in terms of what they stand for. Started with just Spark and then started to, expand out, instead of becoming just a Spark engine, become an overall data platform. But I don't know what's the differentiation between Databricks and Snowflake. Why would you choose one over other, or why would you not just get the services from your cloud provider? And that's
Snowflake
the
is a traditional database company, so it has more understandable product. That's what it is.
What else? What other companies are we missing from an IPO? I know markets have been waiting for many more companies for IPO over the last few years. How about Stripe? So at some point of a time we were talking about $90 billion, and then they couldn't go IPO 2022 because the market was dead, and then 2023, 24 market started to open up a little bit on 2025, but they didn't go IPO. Collision Brothers. What's up with them? Now, now they also have a crypto story. They bought Bridge.io, and they're back in crypto, but still I don't see any news around whether they're gonna go IPO or not. And any other companies on you guys' radar which you're thinking of, hey, whether this company will go IPO or not? 2026. Any
What
other
about what about Anthropic?
Anthropic?
Perplexity.
Perplexity, I don't know. I mean, is Perplexity still that much in news? I mean, when it did come out, uh, it made a lot of waves on, at least on the Twitter. I don't see that being talked about and much more nowadays.
Because the
Perplexity.
usage of that is in academia, right? It's like some of the big financial companies, they work or cater to the academia clientele. They're not in big news. It's likewise perplexity is into the academia, all the universities and other where the research is involved. They use it more
Okay.
predominantly.
So Perplexity. So thanks, Ritu. I didn't know about Perplexity more on the academia side. Anthropic is more on enterprise side, and then OpenAI, of course, more on the consumer side. Uh, so each of these big models are trying to have their own USPs or areas where they are better than the others. That's the only differentiation that they can do. Otherwise, at the end of the day, I think all these LLMs become a commodity. It won't happen to start with, but my thought process is we'll have to figure out the distribution and the usage will matter more than your base LLM models. It'll all become commodity. I don't care whether at the back end the system that our software I'm using, is it using OpenAI, is it using whatever Anthropic or Perplexity. Not Perplexity, doesn't have their own models anyway, whether it's Anthropic or OpenAI or it's using Gemini. um, like I don't care how do you generate energy. Is it coming from renewables or is it coming from nuclear energy? I press a button and the bulb just glows. So I think the bulb will become more important than electricity generation. So the apps that make use of these will become more valuable, but that we'll have to go through that cycle.
I think
So
next year will be more about the moving robots or kind of not, it'll be more than text and pixels that will be coming IPO in the next 2 years.
hmm. Do we think, because I thought that in 2025 market will start to worry about return on investment on AI, but I was wrong. Market is like, doesn't matter if you're not getting returns. When I say returns means from the real companies, not the companies that are providing AI models or infrastructure, but the normal business companies. But eventually the benefit that we're going to get of these AIs when they start to improve their business performance, right? Companies like Home Depots, Walmarts of the world, pharmaceutical companies, when they figure out, okay, I can shrink my drug discovery cycle from 10 years to maybe 6 years or 5 years because I can use these AI models to do some molecular assays, which otherwise the biochemist has to do. Stuff like that. I don't know, will 2026 be an area where we will see that the companies have start to report productivity improvements, except outside the tech companies? In
No,
2025, tech companies have reported that
no.
I can still generate the same amount of code with much lesser developers and hence have a better productivity improvements by using LLMs. How about the non-tech stuff?
Yeah, so
Non-tech
if you
companies.
consider finance to be non-tech, I've been saying for a couple of years, finance relies heavily on this connecting text and numbers and all, and it's hugely going to be disrupted. And last week, Moynihan, BOFA's CEO, go back and hear him. They're seeing major improvements in their.
So yeah, so finance is, I think it's
It's
Tom
very
Lee
easy to
said, or
replace whatever people do as financial
yeah,
analysts.
so it's Tom Lee or Josh, but one of those guys said the finance sector will become more like a tech sector because they're gonna get such a huge productivity by using all this technology. So that's the one sector to watch out for, not to question the deregulation stuff. And third thing is once we see a lot more merger and acquisitions and all that stuff happening, these all bode good for the financial sector. So in 2026, I do expect financial sector to do better than from a sector specific. I see Nick says Canva IPO. I start to have my own doubts about Canva after we see what's happening with Figma. Maybe it's apple to oranges, but Figma, after coming to public market, hasn't been treated well. They were they got a lot more love when they were in the private. Public market is brutal, man. So we'll see if Canva folks wants to go IPO, um, or they just want to stay private. Again, it depends on how much money can they continue to raise in the private world. And so far, we have had good amount of money, and the companies didn't really have to come to public. But once you become public, it's like you're exposed. Then you have to do all your quarterly statements and all that, and there are some certain things that you can't do it. If you are private, who cares? you do whatever you want to.
So, Vivek, that brings one question about this Adobe, right? Because we have Figma in this space, we have Canva in this space, and Adobe, which has like a recurring business, and they're really doing well as far as the cash flow is concerned. Again, growth is not that high. Where does it fit in?
So it's Adobe fits in, or
Yes, yes, Adobe.
yeah. So again, I think the market has right now thought that Adobe's launch will be taken over by some of these new Figmas and the Canvas of the world, or these LLM models of the world, which basically help illustrators to create images and all that stuff. But to me, I feel that's an overreaction, and probably Adobe. Again, as you rightly said, Adobe has been a very good cash flow generating business. Currently, market is not just paying any attention to what they've done in past, because they say we can't see the future, right? Of I am still hopeful that Adobe will still be around. They probably will be able to make use of these AI models and deliver the same business results at a lower cost, and hence improving their earnings power. But right now the market is not rewarding them, because there are other better shiny objects to put money on. Now, nobody knows what will happen in future. I have no idea. Only thing I can talk about future based on how Adobe has done in past, and they've been a good steward of shareholder capital in terms of their business side. Having said that, am I gonna add or buy Adobe shareholders or buy Adobe shares? I don't own any Adobe shares. I don't think I'm gonna buy shares right now, because I'm not adding any. I'm raised a bar of having individual companies, so I'm not looking to add any more individual company, especially which is impacted either positively or negatively by AI. I have enough AI exposure already, so I don't want to add anything which is related to the AI stuff. But if I held Adobe in my portfolio, I think I'll still continue to hold it. That's that's my thought on Adobe. I think the overall, if you look at all of these SaaS companies, vertical SaaS companies, market is thinking that AIs will eat their lunch. I mean, none of them have. I mean, look at CRM. Let me go back to or YTD. Let's look at YTD. Salesforce I think that has underperformed. Salesforce is down 20% for the year. Adobe is down almost 20% for the year. Which other SaaS companies that were like darlings of the markets prior to this whole AI wave last year? Workday down 12.5% for the year. What else?
PayPal?
Sorry, PayPal? PayPal is down 30% for the year. Twilio, I thought recovered. Yes, Twilio is up 28%. So many of those, I think the vertical SaaS companies, Twilio is a little different, it's more on the communication side. But market is like, hey, the AIs and the LLMs are gonna eat their lunch. And sometimes market overshoots on both sides, right? When they reward the companies, they'll probably reward the companies in terms of share prices more what they deserve. And when it undershoots, it will probably punish the companies more than they deserve to be. So the trick is to know and track the business and see how bad the business is. And I don't own Adobe, so I have not tracked it, but let's pick at Adobe, ADBE. Are they losing business? Is the revenue going down? Doesn't look to be. It's not that they're super growing, right? Sorry. From from 20s, low 20s, now they're talking about low teens, right? So that does show that they have been impacted by whatever is happening in the market. So the revenue growth has come down. The question that we need to ask is has the share been beaten more than what they deserve to be? Or given the overall the profile of the company and how the CEOs have been managing their business, how they've been returning the cash to shareholders, stuff like that. If you think that they've been beaten up more than what they deserve to be, maybe then it's an opportunity to continue hold it. Right? I mean, look at that margin. It's still a decent company, like 30% operating margin. So, but will it's going to continue to grow? Probably the market is pricing in that the days of growth are over. Days of mid-20s growth is over, and nobody knows what's gonna be in future. Just like we gave up Google for that, I'm not sure whether will it recover or not. But market also wrote off Google, saying their search is dead, and Google continued to post 15% growth in their search revenue. Anyway, any mergers or acquisitions, reckless predictions. Do you think Apple will buy some company? Will Apple buy Perplexity? Dan Ives keep telling Tim Cook, go and buy Perplexity because Apple has been a laggard in their AI stuff. You have nothing to show for AI. Do you think Apple will buy Perplexity? I'm not going to hold it to you. Anyone wants to make a reckless statement, prediction? Or let's say Apple buy any AI company. Let's not make it Perplexity. Apple buying AI company. Because right now Apple has decided, okay, we'll use Gemini, but given Apple, they want to control the whole ecosystem. So I won't be surprised if they go ahead and buy some company and basically control the LLM that they're gonna use in their devices. What are some reckless predictions on mergers and acquisition? No more predictions. All right, so then let's go to what.
I think there's a one possibility here. It's like a tokenization of the assets and then monetizing that. Let's say you have a house. So the house, you don't sell the house as a real estate. You basically tokenize that into the small tokens and then you sell to the retailers.
We
So
will
that
come to that. We'll come to that. Hold on your thoughts. Hold on your thoughts. When I talk about crypto, we'll talk about what stuff has happened on tokenization because we saw some positive news on that one. All right, so let's see what the Wall Street has to say about 2026. Again, I'm not saying that you should focus on what Apollo has to say, but maybe let's look at what they are saying. So what Apollo says. If you recall, I think Apollo had they managed close to $900 billion. And was it 2 weeks ago? There was some news, and I was recently reading, there was an article in Financial Times also that Apollo is actually becoming defensive in terms of raising more cash and all that stuff. So they are now taking a little bit of a defensive posture in terms of their own money management side. But let's see what they have to say about the markets. 2026 is consistently with the stagflationary environment, which is never good. Right? This is the worst of both worlds. You have a high inflation and no growth, which is what a stagflationary would be. And markets don't like it. Recession risk remain elevated. Earnings vulnerability is rising. So not surprised that Apollo has been focused on generating cash and probably selling their stuff that they feel that they own in their portfolio, which is overvalued. AI remains a central driver for the macro outlook. Nothing different from what a lot of other firms have been talking about. A rare and significant divergence between US and Europe is emerging, which we did see um, in terms of the market performance. We saw the divergence for this year. So Apollo seems to be a little bearish on the markets, stagflation risk, 30% recession probability of in US. And the non-AI related, like non-Mac 7, face meaningful earnings risk. So that's what Apollo has to say. Let's look at what Goldman Sachs has to say. All right. What did they say? So growth, we believe fading tariff headwinds, rising real income should contribute to global growth. So they are looking at US to grow 2.5%, China to grow close to 5%. Inflation, uh, expect the core to fall by 2.3%. So this is little different than what Apollo has been talking about. Central bank, we expect additional rate cuts coming from central bank. I'm not surprised. Uh, what is DM equity? Developed market equity. Consistent with late cycle expansion, 2026 is likely to set opportunities for cyclical acceleration, earnings momentum against the valuations that we order. We expect the former to prevail. So we should see, so again, they're talking about the earnings momentum. We should see mid to single digit returns across the developed markets. We have had decent, almost 20% plus returns over the last 3 years. So high single digit returns, not bad. Emerging markets, we expect emerging market outperformance. I think everyone is talking about that. Credit corporate balance sheets are historically strong with recent credit events clearly localized. So they are talking about the credit events with stuff like Oracle and Meta, wherein they basically went to the debt market to raise funds for the data center investments. They also move towards SPVs. So sometimes when these companies do employ these techniques of doing investments through SPVs and all that stuff, you do worry about it. Come on, you're generating cash, you're a cash flowing company. Now you're talking about, taking all these investments and using an SPV vehicle. Of course, they want to be asset light, not want to have their own balance sheet, and that's what they're doing it. Not the first time that any company has done it, but we have also seen in his past that some of the companies have used and they use these vehicles to hide some of the bad things from investors on their own balance sheet, right? So the biggest example that comes to our mind is Enron, where they had uh, those SPVs, Raptors, wherein all the loss-making stuff they shoved onto those balance sheets and kept their clean, and eventually figured out that that was fraud. So I think market got a little concerned around that, especially with the profile of Oracle, wherein looks like they don't generate enough cash flow uh, versus what their commitments are. So that's why we saw market seeing little concern. But overall, to be, it looks like Goldman is not negative as what the Apollos were. So forecast. Let's look at the forecast, right? So looking at S&P 500, they're looking at 7,200 is their price target, which is like up 5%, 5.1%, right? So at least on the positive side. Let's see what Bank of America has to say. There are 10 macros, more bullish consensus. They are more bullish than the rest of the consensus on 2026 US GDP growth. One big beautiful bill, restoration of TCGA benefit, fiscal stimulus, Fed cuts, and I think we also have the accounting profits coming from how you treat your capital investments. You can write off uh, instead of capitalizing it, you can write off some of those expenses, which should lower down your tax liabilities and all that stuff. Uh, Bank of America says we are not an AI bubble yet, right? And constructive emerging markets, solid backdrop with lower USD, basically US dollar um, cheap, which should bode well for all the emerging markets. More bullish on China GDP growth. And over the last, I mean, China has been in, they have been struggling. So hopefully, Goldman Sachs, they have raised their China GDP growth forecast. So they are a little more bullish than the rest of the market. Muted S&P returns, but expect broadening and strong capex. They do expect 14% EPS growth, but only 4 to 5% S&P 500 price appreciation. So I think the 14% earning growth is fine, but from a price appreciation perspective, because they say we are already, uh, you know, valuation is already high, so price appreciation we might see 4 to 5%. US needs lower inflation, favor long bonds in first half of 26, then that should bode well for TLT. Flattish long rates and US home prices. Bank of America expects the rate strategy for 10-year to end at 4 to 4.25. So, and we know our mortgage follows the 10-year. So that should bring down the mortgage, which will then should bring up the home appreciation prices. Expect volatility. I would love that to see some volatility. Now the vol on Friday, the vol has been like lowest as of last 52 weeks, right? Waiting for vol to kick back up. Private credit returns likely lower in 26. And prefer, I think HY probably is a high yield investment. So 5.4% total returns for private credit. I don't even know what to even say about these private credit returns, because it is whatever number you can make up. There is no validation of, for me to tell if you're a private credit issuer saying, okay, this is the value of the assets. There is no way for me to figure it out. It is what it is. So, and copper to perform on tight supply. So commodities, especially copper, they are bullish on. So bullish on the earnings side, lukewarm on S&P 500, mid to single digit, 5%, 6% growth. Same as I think what Goldman Sachs had, like 5% growth in S&P 500. Let's see what Jeffries has to say. Top 10 global ideas for 2026. Secular innovation, clearly someone had used some of these LLM models to generate this image. So they're looking at Broadcom, Snowflake, Nu Holding, which is a Brazilian bank, Neobank, Caterpillar, VNet. I have no idea what the VNet is. Tencent, CATL, which is batteries, IHI, this is Japan, Goodman, and League Red. That's Jeffries' top 10 global ideas. I don't own any. I think I own a little bit of Tencent. Other than that, I don't own anything in my portfolio. Let's look at what Barron's top 10 ideas are for 2026.
It's kind of Vivek is kind of weird. They're adding caterpillars. We're in the late cycle, late business cycle, and they're adding this industrial company. So it's kind of odd.
Why do you say we are in late cycle?
I mean, I think we are still doing this whole data center investment growth and all that stuff, right?
So
Maybe
basically,
maybe
as
that's why they have
understand it,
Caterpillar.
economic expansion can have several quarters, and late expansion would be when a recession impending is shown as, and the best indicator for me has been yield curve becoming negatively sloped. So we don't have that. So no matter what all these other guys are saying, oh, we are going to have a recession, we'll just have the same feeling of recession coming, but no recession, and America will keep running. So no later expansion right now.
All right, let's see what Barron's has to say.
So I'm in Caterpillar right now.
I don't own any industrial. I would rather, I mean, again, I don't have any insight or much on in terms of how to evaluate one company versus others. So if I were to do industrial, my preferred vehicle will be XLI. Uh, Barron's, let's look at Barron's. Barron's have been talking about Amazon, and I think uh, I will probably on the same boat. Both Amazon and Meta have been kind of underperforming S&P, underperforming Max 7. So that reminds me, I think market does talk about, oh, all these gains have been driven by Max 7 and, rest 493s have been left behind. It's so concentrated and all that stuff. So I did look at in terms of year-to-date performance, all these Max 7s. I think I tweeted about it. I think what, four are underperforming S&P 500.
Yeah.
So that's really not, okay, I think this is,
So we are Mac 3 essentially.
so this is where it was, right? So yeah. We have a four which are underperforming. It's only Tesla, Nvidia, and Google that has outperformed S&P 500. So all the crap around, oh, this is concentrated rally. It's only Max 7 that is driving it. No, that's not the case. So I don't know where. So this was when I posted on 22nd, right? So Amazon, Meta, Apple, Microsoft, these four biggies are just
These companies are going to underperform the AI boom, the four laggards that you mentioned.
Yeah.
And I think that's the reason. And in my view, like when companies are forecasting 4 or 5% growth in S&P, it's because the rest of the carcass in the S&P will underperform, and some of these two or three will outshine.
Yeah.
And that's how we'll
So,
get average for it.
so Barron's does say that they're looking at Amazon to basically be one of their top 10, then Bristol Myers Squibb, Comcast, ExxonMobil,
Oh.
Fairfax Holdings. This is the Canadian Fairfax, Premvatsa, I guess.
Hmm.
Flutter Entertainment, Madison Sports, SLG, Green Reality, REITs, Visa, and Walt Disney. Interesting to see Disney here, though. Bob Iger. But these are Barron's top 10. Surprisingly, no Meta here. Hopefully, I think Meta should come back and perform at least, if not outperform, at least in line with S&P 500. Meta got beaten down after their whole capex stuff, but Zuck has assembled a team of great team of their AI. He maybe overpaid for all those AI talent, and hopefully it'll take a year or two for for us to see what that talent has brought to the market in terms of the new products and innovations. So I hope in 2026 maybe Meta will recover and outperform as S&P 500. Time will tell. I did buy in 2025 after Meta fell down. I did increase my positions in Meta. So I think inherently I hope and pray, or we'll see. I have no idea. But it hasn't performed this year. When I say no, hasn't performed, means it has underperformed S&P 500. But we'll see what happens in 2026. Let's look at Evercore ISI. Their best ideas are around uh, conviction ideas for K-shaped recovery, retail and consumer, Walmart, tax cut spending. So we all gonna get some bet more than expected refunds. Amazon, Ulta Beauty, Home Depot, Genuine Parts Company. Never heard about this company. GPC. Anyone knows GPC? $17 billion, $24 billion revenue, $800 million. What is do? distribute automotive industrial replacement parts. So, new company. Power automation industrial G. Vernova, Honeywell, Hubbell, Schneider. Again, all related to power generation. MediaTek, Live Nation, MasterCard, Arista Networks, and Apple. No Google's, no Metas. So they have one networking company, which is AristaNet, and another one is Apple. And value plays, K-shaped recovery, Mondelez, these are the consumer staples.
Yeah, the way I look at it is in the last several months, like the fade of Meta, etc., Microsoft shows that the market is trying to focus more towards the infrastructure or the plumbing, and that's why Arista Networks is showing up, GE Vernova is showing up because of turbines and all. And you don't see the Metas, and the ad tech is fallen out of favor, let's say, in the last several months.
So if you think Meta and Microsoft are not gonna perform well, then I don't know why you put Arista Network here, because their two biggest customers, their M&Ms, what
Right.
they
So
call.
there's a basically a value chain, right?
Yeah.
And the front of them of that chain or the funnel is these Metas and Microsoft, but the back end is where the reward is. It's like the
Yeah,
picks and
but their
shovels.
two biggest customers are Meta and Microsoft for Arista Network. And if they won't invest, so then I would be a little more concerned on that the Arista Network will not perform, because they are the two biggest customers. One of my risk on the Arista Network is you have a customer concentration risk, M&Ms, which is Meta and Microsoft. Anyway, Lithium Motors, which is automotive retail. What is Lithium Motors? So we get some names that I've never tracked. It's a retailer in United States, UK, and Canada. So we got a retailers. Sure. I don't know. I have no
Vivek,
position in this.
Vivek,
Yeah.
I got a question on AI. Number one, the military took on Grok, and then I believe Facebook properties took on Gemini, right?
I don't know what is a military took on Grok.
Yeah, because they're gonna use Grok AI as their whatever.
Okay. I didn't know. I've not followed. Maybe they did.
Okay, I guess. Okay, forget it. Don't talk about it then. Well, do you see that triangle I stuck in the chat? Can you talk about that?
I didn't know there's so many companies in China in this space. Sheesh.
Car brand positioning. Oh, wow. I don't even know what to even discuss it. So when and I know there are a lot. I was my only investments on the Chinese automotive around the EVs, and that too I realized that there are so many like EV companies in China that it's going to be it is already a very cutthroat market, a lot of competition, and very few companies will survive. So I think I own four of them. I own Neo, Li Auto, Xpeng, BYD, but there are tons of companies.
Can
And
I talk about Great Wall?
go ahead.
Okay, about 30 years ago, Great Wall was a top PC manufacturer, and
Hmm.
then around 1999, 2000, leader Jiang Zemin said, "Let's have top corporations source off each other." So Great Wall got stuck with other companies, and so they got shoddy parts. That's how Lenovo, then called Legend Computer, came out ahead. They couldn't get China. They couldn't list in China, so they did it in Hong Kong. So that's the little thing on Great Wall.
Hmm.
They're on the bottom.
Oh, okay. No. So the Chinese market is very competitive when it comes to EV. And again, I think we will see consolidation happening because not all of them can survive. Companies that at least I own, they keep raising funds like Neo, etc. So that's I'm not adding any more exposure. I don't know. That's why I bought BYD even though it doesn't have options enabled on it, just because that's the biggest and the baddest one, right? At least they have the pockets to survive because there's so much competition. I don't know which one will survive, which one will just fall by the wayside. There's too much of competition. And finally, let's look at what Jeffrey Gundlach has to say. Since somebody invoked Jeffrey Gundlach, he says long the belly, 2 to 10 year maturity bonds, go long, long commodities, long gold, long high quality fixed income, long emerging market fixed income, long non-US equities. So he's not bullish on the equities on the US side, but non-US equities, short USD, dollar weakness, short long duration bond TLT. Guys, I hold that. So he's not, he's of opinion that market will see through what our administration is doing, and the long side of the bonds will still remain elevated,
They'll
right?
go higher, in fact, meaning 10-year yields will go up higher than 4.15%.
Correct. So he says stay
Yeah.
on the bellies but go short on the long side.
But I don't think that's, in my opinion, I don't think that's a problem because the steepening yield curve indicates really torrid GDP growth ahead. So that's what so in here he's not forecasting a recession. Do you notice? And he's an economist. So there's no recession being forecast. These are just what do you call, bull market steepeners.
But I mean, if I don't pay too much attention to economists.
But he's an economist.
Uh, yeah, so that's what I'll bring this
But
up.
he
But I'm not going
manages
to change
trillion
my
dollars.
portfolio
He
based on what
manages
he
trillion
says.
dollars. So that's the difference between him and Rosenberg of Toronto, who's a pure economist. So he always Rosenberg makes forecasts which never come out.
So all economists' forecasts of 2023 were like recession, nothing happened. Anyway, short private credit, which I'm for me to go short is not invest in
That's
private credit. I'm not going to invest. I don't know how they even value the holdings, and short high yield.
I
Interesting, but
think
that's
I like his long commodities. I followed Jeff Gundlach and I'm impressed with him. I love him for decade. And this guy has been saying for more than 12 months, be 25% in commodities. And if you go back and look at the chart of not just gold, but other commodities, they've done pretty well.
so. Let me look at DBC, right, which is commodities ETF.
Yeah, that's a pretty bad proxy, I've noticed.
So for a retail investor, I mean, rather than you trying to pick up individual the XYZ commodity, TBC hasn't done much.
So look at its holdings, DBC's holdings.
Let's look at ETF DBC. What? It hasn't short investor trust government agent port. I don't even know what is this. AGPXX.
Your stock analysis will give you more information about DBC.
See, it invests in a portfolio of exchange traded futures on oil, gas.
Or copper corn. It does have a silver, but silver is like 1.64. So basically, all spread across all the commodities, wheat, nickel, and they're all futures.
Right.
So you do have a carrying cost.
You said the right word. I found in my experience that you have to look at actually how the hell they construct the ETF. So I was dismayed long time ago by one of these ETFs which was doing sampling of the underlying index and not holding any damn thing. And their sampling crap led me astray.
I own DBC only once, and then I realized they sent me K1. I'm like, I'm not touching this. So, but yeah, so instead of long commodities, I think then we should say, hey, copper, silver, gold, be specific in terms of which ones you want to hold or how you want to hold. Yeah, so these are some of the predictions, call it reckless or whatever, of some Wall Street firms. I I think isn't the street estimate highest street estimate for 2026 is close to 8,000 or something? I don't know. There are some targets that we looked at last week, so we'll see. Anyway, coming to the crypto market, nothing much has changed. Bitcoin has been like spin sideways, and still continue to be sideways. We'll see what happens. On the news earlier, I think I was telling Ruto, we'll talk about tokenization. So we did get some good boost on from a regulatory front in terms of DTC received a no action letter. So and these are the depository trust corporation wherein all the stocks that I own, eventually DTC has a record of who is owner of what. And now they received a no action letter saying, from SEC in terms of you can play with tokenization and do all that stuff. And now with Paul Atkins being very pro kind of tokenization, I think he made a statement saying in another 2 to 3 years, all stocks will be tokenized, which board really positive on all these technologies which companies can use to tokenize the assets that so far has been outside of its purview, right? So we did see JP Morgan again doing, I think, one of their bond offering on Ethereum. We saw last year, I think it was Biddle was mm, again made you that was again launched on Ethereum blockchain. So I am hopeful to see that more and more companies, we might see more usage around, some of these real world assets. Housing is not there yet, but I think that the approval that they got was to maybe you can tokenize Russell 1000 stock ETFs that track major indices and US treasuries, bills, bonds, and notes. Not individual stocks yet, but I would see if this is a good start, right? If you start with, sorry, I mean, they do have individual stocks which are only relate under the Russell 1000. But if this can be successful, there is no reason why not every stock that we trade or every financial instrument that we trade on our exchanges cannot be tokenized. Would be maybe just a matter of time. So I'm still bullish about, let's say, some of these Ethereum and some top blockchain projects, because I guess if Wall Street wants to tokenize stuff, they're going to use one of those. Looking at the funds flow, this came from Eric Balchunas. Even though Bitcoin, IBIT, which is the ETF on spot Bitcoin, year-to-date return, whenever the screenshot was taken, is like 9.59%. How much is IBIT as of now? 10.5% negative, right? Even though it has underperformed the market, it's on number 6 in terms of the year-to-date flow. It means the amount of money that has been moved into these ETFs. Of course, the biggest one on the Vanguard is VU, and then of course IVV, VTI, SGov. IBIT is number 6. More money has moved into IBIT than in QQQ or than in gold ETFs. We know gold has vastly outperformed S&P 500, and now you add, it has vastly outperformed Bitcoin. But when you look at them from an allocation and the money perspective, the Bitcoin ETF have taken in more money than gold has taken in. GLD ETF has been taken. That's the biggest gold ETF, right? That's interesting. But let's also look at how the crypto, and this is where, you shouldn't pay too much attention to the forecast, because in Bitcoin price targets for 2025, this is coming from one of the respected, let's say, fellows and maybe the firms in this space, right? JP Morgan 170, Tom Lee 250K, Robert Kiyosaki, Rich Dad Poor Dad 350K. The less I talk about Cathy Wood, better it would be. So if Michael Burry is saying something, who knows what it's going to be, right? Chamath was like $500,000. I have no idea how it will perform in 2026, but I'm hopeful that either it's a 4-year, the whole 4-year cycle. Maybe it has changed because now we have a different environment, and maybe 2026 it will do good. But even if it doesn't, I'll still be okay. Last topic from stocks, buys and sells. Again, not a recommendation, but I had KWEP, which is China Internet ETF. Short put was assigned, so I do want to hold the shares. TTD, which is the worst performing stock in S&P 500. I got my short put assigned. I want to hold this. I think now it has reached my max position that I want to put on this particular ticker. So no more buying any more shares, but I'll play with the current position. And then I bought some ICSH, parking cash, for waiting for opportunity to show up. Markets are all-time high. So I want to, raise some cash if in case we see some volatility, and I can find some opportunity to invest at the stocks I want at a cheaper price. So that's what the stocks buys and sell for this week. What else? That's finishes up what I have for today. We can open up the breakout rooms, or we can talk about anything else that you guys have in mind. Let me see any questions if I missed. Vineet, any idea why silver, gold going up so much? Gold we knew because it's for last 2 years, central banks have been buying gold. The whole concerns around economic debasement, money printing from the governments across the world. So you see that precious metals going up. So silver is catching up with gold. And gold has been going up for last 2 years. Now silver is just trying to catch up with it. Nu has been struggling for last few years. Not a business wise. I don't own Nu stock in my portfolio because at the end of the day, it is a financial services company. But I think from a business wise, they've been expanding. Even the stock also has done fine. At least last 1 year, it's been up year to date for 60%. So I don't know what do you mean when you say struggling? Is it the stock or is it the business? Thought no. Yeah, I mean business also has been doing fine. It has slowed down, but from a triple digit growth, now they're looking at mid-20s, let's say.
I've been holding trade risk and it's down 50% on me. What made you sell a put and buy it and own it?
I had one contract of short put
Right.
for some time.
But why?
I've been rolling because I had one covered call that got called away at 77 or something. I mean, I had one of my covered call had gotten called away, so I just wanted to refill the tank. So I started selling put, and then the stock continued to go down. I kept rolling it until I could roll it further, and it got assigned. That's the whole story.
But now
Not
you will
gone.
own it? What is the fundamental reason for holding it now?
Oh, right now, because it's much cheaper than what it was, there is a risk in terms of Amazon disrupting it, and that's why I've not made it as a bigger position of my portfolio. But outside of Amazon, if you look at any other DSP, that they are the biggest players. Right now, all the concern is coming from because Amazon has moved into that space, and that certain market has now freaked out. Which is right, because if Amazon is coming into your space, Amazon gonna eat the lunch. But it's down 60% for their year, I guess. Right. But they have been the best player in this, or not SPY, TTD. 67%. But prior to that, they've been the best player in the space. That's why I'm still holding it. I mean, Jeff Green is a good CEO. They've also made their pivot with their new Kokai tool, which they use, which helps advertisers to create campaigns and monitor it and get a lot more value from their software. But Amazon can come and cut and undercut them, and that's the big risk. That's why I'm not adding more to it, where it is now available at like 50 after 70% haircut, because I still see because Amazon's still there. So I am just got back the position that I had to start with. That's what I'm still holding it. And again, it's not a big part of portfolio, right? So if it was, let's say 20, like 5% of my portfolio, yes, I would be worried about it. It's a small portion. So I'm like, yeah, let me wait for it to recover. If it can, if it recovers, fine. If it goes down to zero, it's a small part of my portfolio anyway.
Thanks.
And very quick question on this sort of scenario. So, like, because and I've got something similar. So, as you, in my case, sold a put spread on it, ended up with an assignment. And now, when I consider selling a covered call, the premium's tiny as compared to me undertaking the risk that if I try and sell it around whatever, even 30 delta, I mean, I wouldn't even break even on the cost of my assignment. So what's the sort of relatively sensible way to deal with this situation?
There is no other, because the market doesn't care what's your cost of purchase is.
Exactly. Yeah.
Right. Market doesn't care. So that's like water under the bridge.
Yeah.
What we can do is to see if I can sell, let's say if because right now it's way underwater and you don't want to be, taken out if they, let's say if it explodes. So the ideal way would be, instead of maybe selling a covered call, instead of just selling a call, maybe sell a spread, so that in case if it recovers back to, let's say, 40, 50, $60, you are still in the game. You might sacrifice a penny or two, a few pennies to do the spread, but that's how I'll treat it. So let's say if I will start selling covered calls against it, but right now the VIX is so low that I'm still waiting for VIX to spike up. I'm not gonna sell covered call against all my full position.
Right.
Because if the market, if it recovers, I want to be in the game. So I'll sell it only covered call, only on a portion of my position. But if you have only 100 shares,
Yeah.
might want to sell just a spread.
Yeah. Only 100, and you'd still keep it to like about whatever 50-ish days, or would
Yeah. So
be-
if I have to do now, I'll start looking at doing February expiration. I in fact started building my February portfolio. I sold a covered call on Ford. This is, I think, my third covered call on Ford, and it's not getting called away. So who cares? But I'll continue to sell it. Uh, and the first trade I did for Feb expiration was to sell a covered call at Ford. I think at $14.
Right. And what if and thoughts on just selling like a call spread about a year out so that there's enough premium in it to at least make it
That's fine,
worthwhile?
because hey, since now I have a little more time to manage it, I do sell like 45 days out, etc. But if you want to go ahead and sell a year out, and then don't want to be bothered by, managing it on month-to-month basis, go ahead. But do a spread, because if you're talking about a year, you don't know what could happen to this company in a year, right? Maybe there is a news that Amazon is going to buy TTD.
Yeah.
Possible, right? In that case, maybe they're going to pay premium, or the market will, it might double. Who knows? So
Yeah.
then I don't want to be taken out early because I sold a covered call at, let's say, it's trading at $38. I sold at 45, and now Amazon is paying $60. I want to go and sell a spread.
The other thing that you can do is to take your losses on your put option and just buy the call if you think it is so cheap. Just buy the call. And if it does bounce up, you will have the profit. If you never know whether the stock is going to continue to go down or go up. So at least you'll take your losses and buy a chance of making profit when the stock bounces up. That's the other way of looking at it.
Yeah. Melody is asking, will Nvidia go up to 212 again? Oh my gosh, if I had that crystal ball, I wouldn't be here, Melody. I have no idea whether it will go up to 212 again or not. Only market can decide. Uh, but I'm still hopeful that Nvidia will still be, it's still a good business to hold, and I want to hold it in my portfolio. Now, when it will go above 212, whether it will go above 212, we have no idea. And I don't think anyone else has any idea.
It will
Now,
go up, but with drawdowns. So you could see drawdowns, but I think it will go up in the 12-month time
yeah,
frame.
yeah. So, but with Nvidia buying Grok, they are trying to strengthen their position and trying to make sure that when these ASICs come out, etc., they are not, if GPUs are super expensive, yes, they have a play in the other technologies also, right? So that's why they bought Grok, and that does uh, give lot more defense, make their business lot more defensive. Now,
Vivek,
thinking that, I am hopeful that Nvidia will, do better in future.
Vivek, that was the headline I was after. So, does that give a Grok assurance that it is a good product?
It's a different grok, so it's
It's
not
a
GROQ.
GROQ. So we are talking about different stuff. I'm
Oh,
not talking
okay.
about the Grok
Okay, because
AI.
I was going, why? I was very confused. Who owns Grok? So, yeah,
No, no.
okay.
So this is
I'm
so
confused.
So this is a different Grok. So this is a company founded by the father of, or the founder of, a tensor processing unit, TPUs. He was in Google. So he left, and another guy, Sunny Madra, they started this company called Grok. Right now, Chamath is like in on cloud nine, man, because he was the early investor on Grok. I think he made some $4 billion or something. So, and they paid $20 billion for this, to get their LPU technology to make it inference faster. So again, when it comes to training, GPUs are the king. When it comes to inference, that is where they are seeing their market share being threatened by TPUs and other ASICs, and now they want to protect that market share. Hey, if you don't have that much money to pay for GPUs, hey, I can give you new chips which are based on LPUs using Grok technology, which is cheaper than GPUs. And I think from that perspective, them kind of doing aqua hire. So even though the whole, I think overall Twitter, everyone says they bought the company, they have not bought the company. Grok will still stay as an individual company. What they bought the license, the IP license, and they basically got the cream of their team to join NVIDIA. This is just to get around the regulatory stuff of, like anti-monopoly and all that stuff. So Google did the same stuff with Windsurf. Windsurf still exists as a company, or maybe now it is closed. but they bought their IP and got all their best engineers over to Google. So now in FTC eyes, you've not bought a company. So they don't have any play in that, right? So that's what I think NVIDIA is trying to get around that whole FTC concerns. They just bought a license and they got the cream of the crop, which does tell us to raises a point that if you are a employee working in early startup, where does that leave you? Because that company still exists. Company hasn't gone IPO. Company hasn't been bought over by NVIDIA. But so you're still working in that company, and now that company has remained a shell of what it used to be because the technology has been taken over by NVIDIA. The best people has been taken over by NVIDIA. What does that do to your shares? Something that we have to think about. I mean, why would great engineers would then want to work for startups when they see that and I don't know what the deal has been. If someone is aware of some of your friend actually worked in Grok, have been the low level engineers been able to sell their stocks in this? I don't know because this is not a company acquisition. So
Yeah,
it's
but
not.
wouldn't the since they're paying them 20 billion, wouldn't that increase the value of the company and therefore the value of whatever options the employees have? The rules as far as when they can cash would be different, but the value of the stocks or the options should go up, right? Or the RSU or whatever they've got.
I don't know because that will determine by what the market thinks. If market knows that they got $20 billion, but now it remains as a shell of existing company, then they're not going to value it for any future growth. I really don't know how,
Yeah, but it's
let's say
not public yet, right?
yeah,
So,
if it's not public, so you can't even sell it. You got
right.
$20 billion on your bank and you can't sell your stocks right now. Now you're gonna use that $20 billion, you do whatever business you're currently doing, and I don't know, how many customers will they continue to have and all that stuff. So what does that do to those startup employees?
Yeah, but there's some thinking is normally, an employee doesn't have to stay till it goes public to get the valuation, right? If they leave, it's whatever internal value has been set on that. That's my
No, but they
understanding.
can't get the liquidity. How are they gonna get the liquidity? I mean, they could leave, they could encash the shares that have been vested, not encash, they could exercise the shares that have been vested,
Right.
but they just can't get the liquidity unless they can sell it.
True. I guess so.
So we'll see. I know some people were complaining about the windsurf, saying we got shafted, dude. I worked in this startup and now I'm left with nothing because they basically hollowed out the company. Company does exist, but now I don't even know if it exists or not. It's like whenever that windsurf acquire happened. But really, I mean, if you have someone in the company, probably they will know how this whole deal works. But I was just thinking about it, saying, gosh, we are seeing another one happening now.
Well, there must be some way, right? Because all the companies that have invested, right, the VCs or whoever, um, they're also going to want to get that out, right? And the valuation of whatever the company is, a shell, whatever, is going to drive how much they get, which would be the same valuation that the employees would get on whatever shares they've got vested, right?
Yeah, but VC's got an exit. Let's say VC sold, say the VC, the employees on paper, their share must have been valued higher, but were they able to get an exit or not? And again, I don't know how this deal has been. So, so I'm not saying the paper wealth has not increased. Paper wealth could have increased, but is there a liquidity for them or not?
I think usually with the startups, they have certain periods that they're allowed to cash in, right?
Even the junior employees, I don't know what the deal is, but that got me thinking. This the
Yeah,
you know
junior employees are generally left holding the bag in any mergers type things. Unless you have an IPO, and I worked at a startup which actually went public in 2000. Unless you go IPO, you can never be certain as if you're a rank and file employee to get any damn money.
I mean the top they have the parachute options and then all that stuff saying if the company gets bought over they'll have some accelerated exercise, they'll be able to get out of it. So their contracts are formed little differently. They have some golden parachutes and other. I was worried about the, junior levels who join startup with the dream of making it big,
You'll never know.
and they get into these deals. What
Pray
are
for
they
not
doing?
getting merger or acquisition if
Yeah.
you join a startup as a rank and file employee.
Yeah. Anyway, let's open maybe the breakout room, and our plan is we're gonna go for a movie today with family because everyone is out here. So I will drop off to go out for lunch, and then we'll go for movie. But I'll open the breakout rooms, and you guys can continue to talk whatever you want to. Let me see if there are any other questions that we didn't discuss. I guess we covered everything. Okay. All right. Oh, yeah. I can still hang around for at least until 12:30, so I'll still be here for 15 minutes. What else we want to talk about? Any new plan? Does anyone do New Year resolutions? Means actually writing down the resolution and tracking it. I don't do that, but it will be interesting to know if anyone does it and what's on your resolution for 2026.
So I
Hey,
have
hey, Vivek, I was just curious, what your thoughts are on, the explosion in 0-day DTEs on the SPX or, derivatives of the SPX, like the E-mini futures and stuff like that. Because everyone seems to be talking about it the last couple of years, and all these retail traders are jumping on board.
So I mean, I don't do it because you have to monitor your position really, really carefully. I'm not looked for a stats in terms of how many retail traders actually make money in playing with zero DTE. But if I look at an overall stats on retail traders on the derivatives, most of them end up losing money. I'm not
Oh,
talking
yeah.
specifically of zero DTE, but most of them end up losing money on the option trades. And so I don't have any, I mean, I suspect the same would be the case in zero DTE, wherein very few actually make money. But people love the odds of I can double my money in a day, and they do want to play with it.
so what
And
would
the
be
market will give because market makers gonna make money.
so what will be your trading signal to buy or sell a zero DT? Let me ask you this. How do you decide?
I I found, honestly, I've been doing it for the past month or so. And what I really find that works amazingly well is looking at trading with the market maker mentality. So by looking at the volume and the open interest of the option strikes that are heavily traded, especially in the first hour, price amazingly tends to go towards those strike prices because the market makers know that the majority of retail traders, especially when they're so out of the money, that most of them are selling these spreads. And you can actually see the order flow of like all these strikes that have all this huge volume that totally stands out from the other strikes. And then the market makers go and attack them because they see all the retail traders are selling these out of the money spreads that have like a 20 delta. And then you can see price just go towards these heavy volume, open interest strikes.
Mm.
And it happens on the calls and puts. And once you determine the direction, you can just kind of like just either sell put spreads or call spreads and take quick profits at like 25%.
Mm.
Or you could even just bet like a long naked call or put. And then as it gets there, you make like 5, 6, 7 times your because it's all expires so fast. But I see that as a key advantage is if you think like a market maker and you see where the volume of the strikes are at, because they assume these are just sellers of
Okay.
these out of the
You'll have to
money strikes.
I think you should give us a seminar on how you do this because it's involved strategy and I like to be convinced of its value.
No, I love it. I'm telling you, especially if you use the tasty trade mechanics because they have whole like market measures on 0-day DTE SPX, and it's all about selling and taking quick profits at like 25%. So you could sell a credit spread that has an 80% probability, and then if you just take your profits fast at like 25% of the credit, man, you could get in and out in like 10 minutes, and you just need a short move. And if you have a direction of where it's going based on either your own technical analysis or whether or not it breaks out of the first 30-minute range, and you know where the heavy volume of the sold contracts are, you can really get a good edge, and you can really make a like it's blown my mind.
Yeah, I was about to say that I think I saw, now Tom is not there, but in one of the sessions they actually covered did a one full session on how to trade zero DTE. If you go to Taste Live, you might find the recording of it. But even in that session, I believe again Tom said, "Hey, this is more for an engagement. At the end of the day, you really it's like a 50-50 stuff. But it's great to stay engaged and try to play this if this is your if
Yeah,
you
the
really
amazing
want to
thing
do it.
is every day is a new, like before I would sell 45 days out, wait for the stock to do its thing, roll up, wait till 21 days and do all their mechanics. But if you compress it all into one day and you divide the day up into like quarters, like a fourth, you can actually apply everything applies, like the theta decay curves,
Yes,
you
yes.
know, all that applies. It's just all compressed in one day, and it's kind of crazy. Like that's why I see the explosion. I'm not really excited about it. I was just curious
So
if
I guess
anybody else.
so all these people must be essentially unemployed or having lots of time to
Yeah.
do it.
No, no,
I,
no. Most of these people are losing money. Like I do all the datas. Like 90% of these people that trade, retail traders, they lose money. But the market makers are just killing them.
Of
But
course, that's the
yeah,
when you
but
go to financial engineering programs, that's what they teach you, like how to construct these things to pick off people those have those trades on.
yeah, and I feel like I can see behind the curtain a little bit. It's kind of crazy. It's kind of like, whoa, you can see them attacking where all this volume is at.
so like I said, for me, the best thing is I don't even want to play the game.
I don't
It's
have
too much
time.
too much work for me in terms of trying to monitor the position and get in and out and all that
No,
stuff.
but you don't have to monitor it. If you have your limit order to buy it back right away, and
Mhm.
you have your stop loss order, or you just kind of see the direct and you just play small.
And the limit
Everything is
orders
risk
are what the
defined.
algorithms pick off the limit orders. They come and
Right?
swoop like a crow coming down.
Oh yeah, no, they will swoop it, but when you're doing spreads, you put a limit order to buy it to lock in your profits. Like you put a limit order, you sell it, and then you put a limit order to buy it at just 25% of the credit. And it's
What I would
just
say is if you have figured out a good strategy, try to write it down and then we code it into a high frequency trading system, and that automatically does what you're talking about. That would be the
yeah,
dream. That's the
There
yeah.
is much better way to make money in the market than this. It is exciting, but I'm not sure if it is profitable. I have not heard of any big investor who says I became rich and wealthy because they traded zero DTE. So I'm like, okay, whatever.
Yeah, there's winners and losers. It's a zero sum game. You just got
Yeah.
to be on the right side of it and think like a market maker.
But at
Yeah,
least I've
quite.
not seen even one big those who actually make big in the markets saying they got big because they traded zero DTEs.
So how did I don't know the history of these tasty works and all. Did they make a ton of money in options markets and how did they do
No,
that?
so they started. So these guys were been floor traders, right, for 40 years, and then they started company which was Think or Swim, and they built Think or Swim is the best platform for trading options, right? So they built Think or Swim, and TD Ameritrade bought Think or Swim for almost 760 million or some close to $800 million. So that's where they made Tom, Tony, the other guy, the CEO, Eric. They all these group has been together since then. So then they started Tasty Live, and Tasty works as a brokerage platform after they sold Think or Swim to TD Ameritrade, and then recently, not recently, I think it's been what, 2 years or something. They sold Tastyworks and the Tasty Life to IG Group, which is I think Europe based firm to for $1 billion. So kudos to them. Tom has been a very astute, not just a float trader himself, but he's been a great businessman also. He got two exits, man, close to $1 billion. So,
So they
and I think now he's moved out of it. He's trying to do something different. And then he also has some investments in some startups, etc. But these guys were ex CBOE floor trader. These guys were ex market makers.
There we go.
Spent I think 10-15 years just in SPX pit,
They
trading
saw
nothing
how
but
to,
just SPX.
yeah. They saw how to exploit all these naive retail
Yeah,
traders.
and then they knew how the pricing happens, and then they knew that the volatility plays a lot, or important role, and then they're starting exposing these elements right in the trading platform, right? That's why I love Thinkorswim because you can see your IV, you can see your IVR, and all that stuff, which is not there in Robinhood. And I mean, they knew how these things work, and now they also did the similar stuff on the Tasty Work side also. But
A quick clarification. You know, when it has the expected move of, each option with the implied volatility, can you clarify, is the expected move, let's say it says plus or minus 20. Is that plus or minus 20 from the opening price, or is that the expected move from high to low, the expected range of the day?
So the expected move is calculated based on what's the IV of that expiration day is, right? So you use the IV, then you determine using that IV what the expected move is. So I think generally it is what square root of, no, that's a yearly one. So using that IV, you calculated what the expected move is.
Is that expected for the high, the low that they expect from the day, the range? Or is it like, do you add 20 to the top of the opening price and then you subtract 20 from the bottom? Or is it just thought, because that's a difference, right? Like if it said plus minus 20
Okay.
from high to low would be different versus like 40 if you add 20 from the top and bottom.
No. So let's say if I'm looking at here 10.2. Oh, sorry, I'm not sharing my screen. Hold on, let me share my screen. And
it is basically at the current price, wherever the option prices are, that's how they determine the expected move.
So right now, if you look here, this is what NVIDIA, right? 10.205 at 9 Jan. It means from now onwards, 190, the expected move is based on all the IV, is that the NVIDIA could be 200 point whatever 73, or it could be subtract 1026, like 179 point something on expiration of 926 based on the IV. So that's how the current expected move is.
So the range would be 20 then. The expected move, if it's plus minus 10, the range.
The range will be $20 because we don't know whether it's up or down.
Okay. I get conflicting answers on that.
No, I think this is Sri. Do you have any other idea? My understanding is that expected move is this.
Yeah, you were right. The expected move is based upon the last price on the underlying, and it is very close to the straddle position, at the money straddle position of that particular underlying.
Okay, so I think John has mentioned one more thing. This is like a one standard deviation.
Yeah, it is very close to one standard deviation.
Which is basically 68.2% probability.
Right.
Because if you look, because let's say if you look at the VIX, right now the VIX is very low. Like, can you pull up the SPX?
Okay, SPX.
Right, and let's just look at the expected move of the most recent, the nearest expiration,
which is 29th December.
Yeah, and so its expected move is what?
6.66% implied vol. Expected move is $27. 27.
So that's 27, but if you add that to the top and the bottom, that's a 54 range isn't that would imply that IV would be a lot higher if the range is 54 from high to low, right?
No, we're talking about like almost 7,000, and then 50 on 7,000 is very small, right? We're not talking about big movement. It's SPX, not SPY. So 20, so like 54
It's
on
0.5% each way, so that makes sense.
Okay,
Yeah.
so that makes sense.
yeah,
Okay.
percent-wise is not that big a movement.
Okay.
And of late, the expected movement has been shrinking, and
Yeah,
all of a sudden it is
that
going to
hat was
jump
all
back up.
dirty and sandy. Is that the one that you left on the sand?
Oh,
Okay.
Okay, I
All
think
right.
we're gonna mute David. And if you want, you can actually plot expected move. There are studies on Think or Swim. I used to have that. I don't make use of it anymore, so I don't even know where the study is. But if you Google for an expected move study, actually for each day, you can get a plot of, this is, you basically get a dots around that day saying this is the expected move.
In the analyze page, you will be able to see that as a probability cone.
Yeah,
there.
that will be here. Yeah.
It's the same thing that you're looking at on the chart.
But I've seen some charts wherein some of the traders, they'll have expected move plotted
Yeah.
on the candle, and then they will go back and see like, hey, this week SPX, like out of 5 days, 2 days it actually had moved out of expected move. Or the other thing is when the market, like people like us or those who, the general public who say, oh, market is so volatile and all that, they'll go back and say, like, no, it has been within the expected move. You feel it is volatile because you did not know what the expected move is. So if you can plot there is a study which you can use to plot expected move, and then you can go back and look at it. We thought it is too volatile, but the option market is all priced in. It was well within the expected move. So
Cool.
yeah, I used to have that. I don't have that anymore. Because now I changed the way I invest in, but I used to have that expected move plot on.
Try the probability of expiry cone.
I mean, that is still, but it also plots the previous day expected move. Let's say for this day, what was the expected move? And we'll plot that. And I know that whether the actual movement was more than the expected or not.
Are you talking about ThinkPack?
Sorry?
Was it based upon the ThinkPack that you were able to see the previous expected cone?
No, there was a study. I don't know from where I got it. But so you will see like a dots plotted here, which was like the horizontal lines, which will show, okay, this is the expected move for each days. Then you can go back and see, oh, did it, if the SPX never crossed its expected move, it means the market has been just within the range what it was supposed to do, even though you might have had like say 1%, 2% move up or down, but that was all priced into the market looking at IV.
The Theo trade has the expected move range.
Maybe probably I got from
Theo
that guy, right? The bald guy. I remember 2021, I used to listen to him. They used to do end of a day stuff. So maybe I got from them. I don't remember.
Vivek, have you looked at the 2025 prediction and see who were the ones who had a good year?
No, I was actually searching for 2025. So looks like last year we didn't do that. I was searching for where was 2025 predictions. At least I couldn't find it in my notes. So it means I did not capture. I had the only one I could find was a 2020 at the end of a 2024.
You might be able to find them anyway and see what they do.
I didn't spend time in figuring out what Wall Street.
Okay.
The Bitcoin one was 2025, right?
So
yeah, Bitcoin is 2025, and that's been horribly wrong. None of them were right.
So Gundlach's gold prediction turned out well. I wish I'd listened to him. He had said 25% in gold.
Dude, then Peter Schiff has been talking about gold for all his life. And he's saying Bitcoin, is crap.
I
And
don't like
Bitcoin is
broken
up.
clocks. Broken clocks are the ones which have the same forecast forever.
Yeah, and then Bitcoin has like been up gazillion percent, but this year it hasn't performed. So he is like jumping all over a Bitcoin community. Anyway, so like yesterday I was telling you, I was in a startup pitch event, and one of the founder pitched a company which is basically giving an API to do an inscription on Bitcoin blockchain. So I quipped. I said it wasn't on my bingo card that I'm gonna hear about Bitcoin inscription after 18 months. I'm like this thing became very this thing blew up when the new changes went into Bitcoin, and then some of the folks wanted to use Bitcoin blockchain for creating a unique each Satoshi as a unique Satoshi by inscribing some content um, after the taproot upgrade happened. There's a story behind it. Half of the community didn't like it. Half of the community, no, it's an open protocol. We should be allowed to do whatever we want to do. And yesterday there was a one founder pitching in an API, which will allow anyone to do that. So looks like some stuff is coming back.
Any thoughts on what happened to Oracle after that big jump up?
I mean, that jump up was, in my opinion, that was just a exuberance. And what happened to Oracle is the fact that when you look at Oracle balance sheet, and then you realize they don't even have there's going to be a negative cash flow if they have to commit and pay for all the data center expansion. That's what spooked the market.
I sold at the exact peak of that price on
and
that day, the moment it was released.
And I bought a put spread. I think that's my, let me see, how many actual long put spread trades I've done. I know for Oracle I did. But yeah, but because I'm like, that's too, what do you call, too much too soon. Market just got exuberant on $400 billion of RPO.
Vivek, on Planet Money NPR, they featured who pays for the data centers, and they pay about, like, Oracle will only pay like 70% of it. The rest of the public pays for it.
Oh, for electricity purposes?
I think so. Maybe you should listen to it. It's on Planet Money, and then they have a shorter one on The Indicator, both on NPR.
Okay. Yeah, I used to have the Planet Money podcast on my phone. I don't have that anymore, but maybe I'll go and listen to it. I don't know. I mean, it's not going to be a sellable option for the lawmakers saying, hey, these data centers, the public is paying the price of the higher electricity cost because of these data centers. But we'll see how it works out.
Oh, except Vivek, my electricity bill has only gone up 50%, not the 3 times that I claim.
Oh, okay. Okay.
In 5 years.
So now you have extra money. You're not paying as much as you thought you were.
No, it still went up 3 times, but obviously I use more electricity than I do the first year I lived here.
Yeah, that's different. Anyway.
And talking about Tom, he was just playing around with his paper money, or not paper money, I should say, play money during his trades on the webcast and all the webinars that he was doing. And he knew exactly how to manage his portfolio and make money in there. The money that they made is by opening a company and selling the company, and that is how they made the biggest money that they made. And
That is
they
true.
deserve it. And they deserve it.
Yeah.
So
He
basically,
built the best platform. Thinkorswim is the best platform for the option trading. They also made money with all the other things that they did, lending out the money to others and all sorts of other charges. So they made the money. Good for them.
Right. So money is made by concentration and it's preserved by diversification, and nothing is earned by trading. I mean, you preserve it, but you wouldn't be growing it exponentially.
Yeah, exponential growth is by owning the company and developing the company and selling it to somebody at a higher price. It's not by trading.
So now that's why I started focus on investing, is because I don't think I can start a business at this stage of my life. So I'm like, rather than me starting a business, let me
come
find and
on.
own a business.
You're still young, man. You can do.
Come on. I want to enjoy my life.
Open what is called RIA. You can certainly do that. You have all the chops.
I will take 1% of the monthly returns from your account.
Being a RIA, so many RIAs who don't know, kind of even deserve to be there. But
so if you look at the most RIAs, and and I think maybe Josh Brown, he got slipped from his mouth in one of our podcasts, was he comes and talk about all these individual companies on CNBC and all that stuff. But in one of the podcasts, he said that all our clients' money is mostly in S&P 500 and ETFs. I'm like, when it comes to managing other people's money, all you're doing is what anyone else as a retail investor can do is just put it in S&P 500 and just forget about it. Right. So
better than being an RIA, or at least to me, what would be impressive is to create a hedge fund where you as a principal have a skin in the game, and then you can essentially clearly demonstrate to the investors that you grow with them.
Yeah. So that probably might be still on my agenda, is to just start a hedge fund. I don't know. We'll see. So far,
come on.
I'm enjoying this,
I will
and
join you. I'll join you. Come on, let's open
and I
a
don't
hedge
want to
fund.
get distracted with.
I'll
And the other
join you
thing is,
too.
because right now I know that I have a permanent capital, I can make a decision the way I want to. I'm not bound by any regulations. I want to invest in freaking Bitcoin or shitcoin or whatever crap coin. I can do whatever I want.
If you want to open a hedge fund, look at the 12 different hedge fund styles, one of which you must adopt. Like, for example, macroeconomic focus or fixed income arbitrage or merger arbitrage or blah, blah.
No, then I won't want to don't want to get bound by.
Yeah, because you have to mandate then. You have to follow the mandate.
Yeah, that okay, there goes my hedge fund idea.
It is a discretionary hedge fund.
Yeah, there is a discretionary bias hedge fund as well. Yeah,
That's what I'm saying.
But then you have to show the kind of outperformance each year. Essentially, you have to monitor your track record month by month for several
Which
years.
I do. I've been monitoring month by month since 2017.
I do also.
My own performance.
What has been your alpha?
But my own performance, I've been monitoring since then. And I'm like, even this year, I have outperformed S&P last year, even year prior that.
But your benchmark should not be S&P, it should be QQQ, I think.
No, because my biggest position is still S&P. I do have tech stocks, but I have also have a lot of non-tech stocks. My biggest position S&P 500. My second biggest position is not a tech company. It's an e-commerce company. So I don't want to benchmark on QQQ. I want to benchmark on
it
S&P.
does not matter.
I always beta weight my portfolio on S&P.
You can always show them that you're comparing it yourself to something that as long as you're beating something, you're okay with that.
So
that is how the mutual funds and everybody does. And they select a time period from what date to what date, and then they show that they're outbeating the index.
Good thing is when you're managing your stuff is your permanent capital, right? So nobody can come and say, "Oh, market has gone down. I want to take money out," but that becomes the worst stuff. So
no, that's good. in a way, it is good. You can put in the money at that time.
Yeah,
Put your money
exactly.
aside and
Yeah.
then get involved when everybody wants to take their money out.
So
Hey, Vivek, what were your 4 C's that you talked about last week again? I forgot to write them down.
my forces. So let's start with first is company. It means with whom I want to work with. I can't have that freedom if I'm in a job. Another one is coordinates, right? I can work from wherever I want to. Third is control on my calendar. And last is that it brings also money to pay the bills, cash.
Got it. Thanks.
Right? So what attracted me towards focus on investing is, hey, all these four is important for overall quality of life, and then I decided, okay, let's focus on this. There can be any other jobs where you could have more cash, more money, but you need to figure out what you want to optimize for. I worked many years just for money.
Hey Vivek, do you still offer the Option Gig Pro membership?
No. So that business, not business, right? That stuff I closed long back because I just wanted to focus on becoming a better investor. And I share everything for free. So I didn't want to um, get distracted by trying to increase the subscriber game, but I wanted to put all my focus on how to become a better investor. And I've probably made a lot more money by doing good investments than trying to create something for trying to grow subscriber stuff. So that's why. So, but I think you still have to register for it, but once you register for it, you can see whatever earlier used to be behind paywall. Now it's all open.
Got it. Okay, thank you.
Yeah. So I opened it, I think after 2021, I said, no, I want to focus on a different way.
How
So
often do you upload these meetups on there?
every week, before the end of a Monday, I try to generally upload by Sunday, but if I'm not done on Sunday, I'm due by Monday, and then I put a message in. Whenever you see the message on meetups saying recording has been uploaded, it means I just finished uploading it, and then I put a message.
So you keep your AUM flat or constant in order to kind of monitor that you have alpha over a 12-month period, because I keep adding more funds and over time it becomes hard to figure
No,
out.
so you can still use. Let me give you the methodology that I use to track.
Because I would like to see time weighted returns,
Yeah,
which
so
is
I do time weighted return.
wow.
Exactly. So let me tell you, I'll give you the link. I think Motley Fool had a link that says if you have money coming in and out, you should be doing your time weighted return. And then I basically use that to track my performance. Hold on, let me just find out where the link.
I do the same thing, but mine is a little bit cumbersome, I guess.
Okay, so here is let me share the link, which is okay. So this is how I calculate my investment returns. So right now I'm looking at I basically calculate at two categories. One is my active accounts, and the another one is my non-active, which is mostly retirement, all that stuff. So I'm on an active, I'm 34.49 as the end of November. So December, once the December closes, I look at December. So which is almost, yeah, it's more like 1.5, almost double of S&P 500. So
Okay, thank you very much for the
yeah,
link.
but this is what I use, TWR, time weighted return. So at the end of a month, I go back and see, how much cash I put in. This year, across the account because I have to pay bills. I actually have taken cash out from my investment account because I don't have any other source of income. So I took cash out from my investment account, and but at the end of a month, I'll see what's my balance is, what's cash inflow and outflow, and then use the methodology that you see in this article that I shared to calculate my half period return and then overall time weighted return at as of YTD.
Is there some spreadsheet available which does this or tooling? I guess we
Yeah.
have to. Yeah, anyway, it's too much work.
How do you reinvest dividends? Yes, I think on my retirement account, it is set to drip. On my non-retirement account, which I actively monitor, I've not set it to reinvest dividends because then it will buy additional shares, right? And then the way I track is I know exactly when I buy or sell, I take a note of it, and then it updates my portfolio, which I want to track. So on my trading account, I've turned off reinvestment or dividend. But if you're not that active, like on my retirement side, it's my dividend get reinvested. Just that on my trading account side, because I come and say, okay, this is what I bought, this is what I sold. So if dividend get reinvested, then I got additional shares, and that become too difficult on every quarterly basis to me. Do you have any tax saving strategy, especially last week of the year? So I did do tax loss harvesting, like some of the stocks that I had bought at a higher price than where they are today. I sold, let's say, a portion of it and went and picked up that tax lot. Let's say if I own 400 shares of a company, I think I did for PayPal, and I sold, let's say, 100 shares of PayPal, but I went and picked up the price and used that tax lot of 2021 when PayPal was like 200 plus or something, and to do that tax loss harvesting. And then, I'll sold a put against it for expiration. If it gets assigned, I'll refill the tank. But I have done tax loss 2025, especially. I've become very conscious of making sure I don't pay any more taxes than what bare minimum I have to. And then
a lot of people think about holding their position for capital gains and all the other sort of excuses, but they don't consider the amount of losses that they can incur when the market turns down all of a sudden. And the other thing is you can do a charitable contribution, and that might be one other way of getting your taxes reduced.
Yeah, you can give your stocks to charity.
Like me.
I already do this and other community service. I'm not that generous to right now give my stocks to charity. I need to pay bills.
On the tax loss harvesting topic, the other thing I'm seeing coming up more and more often is this direct
indexing.
investing. Yes, exactly. So where the likes of Schwab are now coming up with these, I think they call them SMAs. So yeah, any thoughts on that, Vivek?
So I mean, that's a good way if you can. I don't know if you want to take some surveys of that, but the whole concept, I understand the concept, and it's a good concept. You could do it individually also, but then you have to hold, buy individual components S&P 500. But overall, what the concept behind direct indexing, and which has now become a lot more popular, as you rightly said, is if you buy S&P 500, let's say if you bought S&P 500 and S&P 500 is up 18%, right? So if you sell S&P 500, you're gonna incur capital gains tax. But let's say within S&P, instead of me buying S&P 500, if I bought individual companies, there are a lot companies in S&P 500 which are actually down for the year. I could have sold those companies and could have done a tax loss harvesting. So that's the whole concept on direct indexing is you still maintain your similar exposure as of S&P 500, but instead of buying an ETF, you're directly investing into it and you have more opportunities to do tax loss harvesting. For example, let's say, I don't know, let's say if TTD, right, is like 60% down. If I do direct indexing, let's say you don't own TTD, but if you've done direct indexing, you would have had some shares of TTD in your portfolio because it's part of S&P 500. You could have just sold that portion S&P 5, that TTD to get some tax loss harvesting. But if you only had S&P 500, it's up 18%. So that's a concept and it is becoming popular. I think there are some companies that allows you to do it because they build the whole software which will do these direct investments. Like it's for you and I as a retail investor, it's impossible that if I'm putting $10,000 into S&P 500 divided over 500 in the same proportion at which S&P 500 is. So I think there are companies which have built software which allow you to do that. But this is an intelligent way to do another same concept of tax loss harvesting.
And so I imagine they do it like once a year. Let's say, oh, they book a profit on Google, book a loss on TTD, and basically rebuy the shares, so you still maintain a component of TTD in your portfolio.
Yeah, I think they probably would employ some strategy saying if not exactly TTD, could you buy, another one similar to TTD? So I don't know how exactly do they do it,
Right.
but I was just explaining because this term direct indexing has become more popular. I'm hearing this term more in recent times than I've heard in the past.
Yes.
So this is exactly how it works. So now, did I think I want to do it? Because I already was. I mean, like I'm individually monitoring my positions and trying to take a tax loss harvesting. So I didn't try to do that because I don't even know if I were to, go and take services of one of them. Do I need to transfer my money? How does that work out? I have no idea.
I think Schwab is laying in charge of about 0.4% annual management charges and a minimum portfolio size of 100K. And I imagine it needs to be in a single account. What I wonder if there's a certain tax bracket this sort of thing makes more sense for. Because the idea is to get a tax exemption on your overall income tax return.
So let's say like a person like me who has huge amount of cumulative capital losses coming from over 10 plus years. I don't care for tax loss harvesting because all capital gains are great welcome. Just as wipe off. Otherwise, I've accumulated. So it's I gather none of you have accumulated capital losses flowing from years. You each
Oh
year have
no, I didn't think you had any losses altogether.
really? No, that's not true.
Well, you keep telling us that.
Did I say that? I think you inferred wrong.
No, you say that instead of buying or selling the put, why are you not getting short on that one?
And
Or when are you not, why are you not getting long on this
So
one?
how does your first statement follow from what I said? Think about
Well,
it for a
I,
second. I
I
never said I
expect,
have only winners.
no, I expect that you would be doing
You
everything
expect.
right, that you don't lose anything, and that's what I'm trying to infer.
He'll be
That's
the
all.
first person who is not lost to the market. Everyone loses. I have my own losers. I have some stocks which are down 80%. Come on. Overall, still fine.
So what I'm saying is like the tax loss harvesting is immaterial if you have cumulative losses, which you need to.
Yeah. So next year, I have to worry about because I think all the big losses I probably already taken. So next year I have to worry about, damn it, if I'll have to sell something to pay the bills, I'm gonna hit by a tax liabilities.
The day that you have to pay taxes on your gains, you should be happy that you have reached the stage where you're successful. That's the sign of success.
No, but I mean, I used to be, but nowadays I
I'm
feel
not talking
different.
about you, Vivek. Everybody in general. But people try to avoid taxes and they are trying to do something different and they get screwed.
Exactly. I guess I don't. I'm not bothered about taking tax. I mean, being hit with taxes. But to speak, I think this thing is also very cyclical. So when you are seeing lots of capital gains taxes hitting you, better be wary, because there's another end of the cycle also where you'll have huge capital losses.
Yeah. So I like on Friday I rolled out my Palantir covered call, which I had at 100 and I've 175 because I thought I don't want to take an assignment on it and then it will be additional lot of gains on that when I rolled it out to January, saying hey, at least let's push it out to the next year. I have 175. I think I have total $13 premium on it. I've been rolled it couple of times, but I was trying to avoid covered call assignment on some of the stocks in which I have a huge gains just to not take any more gains in this year. I thought I will net out at a zero between my two trading accounts, but no, I still have some taxes to
But
pay.
like
But
she says, I think you shouldn't be so worried about this aspect. It's more important to get
Vivek,
more capital gain than to kind of do this dodging of taxes here and there.
So
and
next
again,
year I'll have to do it. I'll have no choice. Next year, that's what I'm gonna do it.
the question is, if you're rolling, is it not short-term gains that you get on your position?
Oh, but the
In
rolling
your
the short-term gain
option,
only
I
on
should
option
say.
premium,
Yeah, but
which
still,
that gain is small. But let's say if my stock get called away because the
but
extrinsic
it's
value went down, then I have a huge gain from when I bought the stock, which will be maybe in $20, $30. I don't even know what I will have to go.
But
Actually,
that's not
Tastables doesn't show it, so I can't. And now it is 175. That will be much bigger gain.
but you're paying a less amount of taxes on your capital gains, isn't it?
yeah. And I think the difference between ordinary income tax rate versus long term is not that much different, right? Is it? Anyway.
So,
Well, anyway,
but the percentage is less, but the amount will be huge because like the capital gains on selling of a stock, let's say if it is $25 was my purchase, but now I'm selling 175
I've been there.
versus versus the
Oh,
option because I rolled it, I made an option income right now, and that amount will be much lesser, right? That will be like maybe a 15. I think whatever. That amount will be much lesser. But I will sell it because it's 175. I think it is overvalued. I've been thinking it's been overvalued, but maybe next year I won't defend it. Let it be called away because I have to. I need a cash for the next year also, and Palantir 175 is good enough for me.
you're talking about S&P 500 index and a lot of calls and buys and all of those things. Is it not the same thing as the long and short SPY index or something to that effect?
Questions to me?
Yeah.
So what?
It's the same thing as S&P 500, which are losing or has lost money. Those are the ones that they're trying to sell, and they're buying the ones that are going up. It's something very similar to the long and short ETFs or any portfolio that they run, long and short ETF or long and short portfolio that they manage.
But I think
And
SPX liquidates everything to cash value end of day.
yeah,
I think what he is
apart,
referring to is there are some hedge fund
They're
like
a hedge
things
fund.
called long short funds where they try to be X long and 1 minus X short. You're referring to that, right, Shri?
right. And it is the same thing,
No, it is
it's the
not. So
long.
No,
this
no,
is
it's not.
what this is basically letting retail investors have a way of creating their own S&P ETF in which they decide how much to be long or short. Not long or short, but like sell, right? Is that
Tax
right?
law. So this direct indexing is for retail investors to have exposure similar to SPY or SPX, but have an opportunity to do a tax loss harvesting, even though in aggregate S&P 500 has gone up. So even though S&P 500 is up 18% for the year, but if you've done direct indexing instead of buying S&P 500 ETF, you would have at trade desk in your portfolio, you would have at some other companies in your portfolio that have actually gone down for the year, and you can sell those to reduce your overall to basically do a tax loss harvesting. So this is different from the long shot, because long shot hedge funds will try to profit both on the long side as well as on the short side. They identify some short opportunities to short and long opportunities to go long with.
Is it not the same as the beta weighting of the S&P 500?
No,
Close
I mean,
to.
In
not
this one, basically,
Close
you
to.
are allowed to instruct the ETF to do X, right? In the direct direct indexing, you get hold of a ETF which you can kind of say, this little slice I don't want, or I want to sell, right? Is that I don't know. I'm not into it, but
so.
Yeah,
So let's
Shri,
assume
it's about tax efficiency. So when you
exactly.
tax loss harvest, like you sell, okay, so let's say Pepsi is down, you sell it,
You can do
capture
it.
the tax
You
loss
can
and
do it
buy
on your
Coke.
own. You can do it on your own. You don't need
right.
somebody
But this is
else.
for people
Yeah, but
who are
with 500
introduced to a
stocks,
thing called S&P 500. So a vehicle being is offered, which is like an S&P 500 ETF, but with the privilege that you can sell a little bit out
Yeah.
of.
I mean, doing it for 500 stocks is very difficult. Like if I were to buy 500 stocks to mimic S&P 500 performance, I mean, it's very difficult for me as an individual investor to do it. So
I just want to have a control of my money myself, and I'll decide what to sell and what to keep.
all right,
I
so
believe
I
some of
have
these new
to.
firms like Wealthfront and Betterment, they have features that they do the tax loss harvest, which can increase your overall yield when you have more efficiency in the taxes.
Yeah.
So
So
you
guys,
can
I have to
show
drop
more
off,
profit.
but I will make Shri, I'll make you as a co-host, because so that you guys don't.
I don't think there's anybody else over here in the breakout rooms.
All right, guys, thank you very much.
Enjoy.
Thank you. And we'll talk again now in next year, 2026. See you in 2026 then.
See you, Vivek.
All right, bye-bye.